Okay. I think the music's at a good level, right? Welcome back, everybody. It's no surprise, most of you guys have probably seen, the market is in absolute turmoil right now. One daily candle signifying the open of December, the end of the week. Obviously, we had a weekly close, a monthly close, and a daily close. Has resulted in a pretty nasty move so far. So the question is, where do we go next? I am, as much as I don't want to, I'm leaning more and more, to the bearish side, unfortunately. There's been a lot of mention of these divergences that have been built. Traxy brings it up pretty often. If that is the case, and the divergences are going to play out, the bearish ones, then we'd be looking for the low that created it, which is here. Now, the reason why I don't really like the low that created the insignificant higher high is because it's resting in the same spot as the previous high. So this was sort of the 2024 highs that we made, right? Around 70,000. Then we went for it on Bitcoin. We made a high above 100K. Saw the market come down. You can argue because of tariffs, but corrections will happen. And the structure did break here at some point, which I talked about. Market was able to make another all-time high, but it wasn't very significant, which is quite unfortunate because I think there was a chance that we could have really ripped it here, but because we didn't, we need to accept that reality. Now, normally when this kind of stuff happens, I'm not a huge fan of monthly divergences. I've said that a million times, but if it is to play out, then it would mean taking out the low here that created that insignificant higher high. So Bitcoin gets above 100K. We find a low, which eventually takes us to another tag above 100K, this time quite deep into it, right? 120 in the 120Ks. But this is the low that created that move. So if the divergence is to play out, this will be decision point. Ideally, don't even want to get here because it could mean the start of the bear market. The reason being is because of this previous high here. Normally, this breaks down the structure if we were to go underneath it. I guess the optimistic world would be dipping into the 60Ks like a couple of you guys mentioned weeks back. Although I think that this decision point is going to be extremely scary if it comes down to it. Because there is part of my analysis that leads me to believe that going underneath 74K would mean the start of the bear market for crypto. I guess there is a world where we do hold it, but just like previous rallies that I've talked about in these last couple months, I'm going to be very stringent and conditional on whether or not these rallies are going to have any legs to them. When the structure broke here, I told you guys, I don't necessarily want it to go down, but anytime we get a rally in this downtrend, I'm going to be pretty conditional on whether or not I think it's going to take us to a new all-time high. Of course, I have been rooting for Bitcoin to do so, but the chart obviously is the chart, the price is the price. So I'm still in that camp of being very stringent on whether or not the little rallies that we do get will lead to something significant. And I would say after today's price action, I'm even more conditional on that. So pretty much anytime you see a rally come out of crypto, you're going to have to be very critical of it unless it proves otherwise. This will be one of the big decision points, but I fear that there's a chance that Bitcoin will fail this decision point. If that's the case, then we could see significantly lower prices. I don't think Bitcoin's going to die. I don't think it's going to go to zero. But it opens the door to start questioning, how low could we go? I think 28,000 is probably a bit extreme, but in the event that, let's say, Sailor starts selling and it becomes an absolute frenzy, there's a world that we get that low. I don't think it's very likely, but that still exists. Again, the first thing that we're going to have to look for is going to be in this little circle that I have. It's pretty much the decision point because we've finally taken out the low that created that insignificant higher high. I'm just worried about breaking the structure here. The market will definitely be able to tell us whether or not structure has been broken, and we can look at the more local structures if and when that happens. I still think it's a bit aggressive to short where it is right now currently. Not to say that it won't go down, but the short I talked about on last stream was this one here, if you guys were here. I also talked about a potential long opportunity, but it got completely dusted. And if you remember, I told you guys, watch the price action here. Don't just fucking take a limit order because you can't really swing it anyways. So this one worked out fine. I'm sure a couple people in the chat grabbed it. This one, I can show you the low time frame, but there was really no strength at all. I mean, on a zoomed out picture, it obviously went straight down, right? Even when you zoom in though, and here, I'll just show it to you guys. Even when you zoom in, it just went straight down as well. So there's really no opportunity unless you tried to take a swing on it, but the stop loss wouldn't be that good regardless. So the plays for shorting keep working out. Unfortunately, the plays for long get absolutely crushed. But the good news is when they do get crushed, at least there's not feigning any strength there. So there's really no confirmation for scalping it. We're getting pretty low right now on this little structure that we built for the last couple weeks. So the low that came in was around 80,000, right? There is a world where we build better structure because we did leave behind a lot of equal highs. So that is still fragile on the bear side of the market. The question is, with the top side of the market being so fragile, why are we not able to take it out? When you have all this fragile structure on the top side, and you're not able to take it out, it's pretty damn weak. But we have seen this before in the upward move. We saw it last year as well. More specifically on Ethereum, but also on Bitcoin. Leaving behind fragile bearish market structure to eventually take it out. So that's some pretty big silver lining. If and when we do find a bottom, the comeback should be pretty strong just because we keep leaving behind fragile structure on the top. There's another occurrence of it here. This one was fine. There's no fragile structure. Bears actually did really well there. But there's even more all the way up. So the question now is, how low can we go in these last couple weeks? How low can we go right now to challenge what we built in these last couple weeks? The lower we go, the closer we get to potentially creating equal lows. Equal lows, like let's say we do get a strong bounce from here on Bitcoin back at 80,000 again. Might seem good to the layman, might seem like it's support, but just like how I talked about it being fragile structure on the top side, that would create the same scenario on the bottom side, which would also create fragile market structure for the bulls. So I don't really see much here in terms of bullish structure yet. This structure that we built here was kind of sloppy, but it was good enough. Showed to you on the lower time frame. You can see that the fluidity was good. Did create a lot of equal lows. So since then, it's been completely dusted, which means this whole local structure is kind of in limbo. Unless something is built soon that looks bullish. At this point, it really doesn't. But of course, structure still could be built that's bullish as long as we don't get close to the previous lows here. So there's a world where it builds something strong, but even if it ends up building something strong after we see a bounce here, then it's not going to be strong. So to put it simply, decent structure could build in this void. We'll have to wait and see. I'm not super confident that it will, but it is possible. If we test down here and bounce, and then we start to build, say, decent structure, then it doesn't look good. So bouncing down here will pretty much invalidate any good structure that we could form afterwards. But if we form good structure now before bouncing down here, then there's a world that will go higher, squeeze out these equal highs, and then find even more short opportunities. At this point, if you're not considering hedging against your holdings, you might be in for a pretty rough ride. You don't have to, but the next area to look for to short, if you did want to hedge, is going to be the same thing now, but on the inverse. So this circle is still valid. When we look at the structure on the way down, we now look for the bearish fluidity to hold, which would be around 88.6 to 89.25. So something like this. The only issue with this short is there was a void that was created, so there's a possibility that we just go straight back up and break this whole bearish structure. But if we don't, that's a pretty big indication that we're going to go a lot lower. So because we went straight down here, right, there's not a lot of data that would back up the idea of the market dumping there, because why would people sell there? But if the market does dump there, in lack of logic to dump there, that's showing pretty immense supply overwhelming the demand. So it is important to try and reclaim, for the bulls at least, to try and reclaim 88.6 to 89.25. But in the event that that does not occur and we dump from that area, it means that there's a very good chance we're going to be making a low lower than this low. And then we'll be put pretty much to the big test of whether or not we're in a bear market. We already failed what I would deem as one of the biggest tests, if not the biggest one. Of course, with the S&P doing well, the S&P likely gearing to go make another all-time high, it definitely does provide good market sentiment to help Bitcoin. But even though we've seen the S&P do well, Bitcoin has still been struggling. So that shows pretty immense supply in the market, at least who's in control and how much supply is coming in. And certainly when we see good fluidity with a bunch of equal lows left behind, it leaves a recipe for something massive to come in. And I also think, because the month just closed, usually have algos reset risk and month close, weekly close, day close, all at the same time. That's usually with a bunch of equal lows. That's a recipe for potentially a big dump, and that's of course what came in. So we've got some new icebergs setting up on the bottom side, which is a good sign. But the bad sign of this is they're setting up where these lows are. So that means that price does dip into the bottom side icebergs again. It could find a bounce, like I illustrated here. But what that'll end up doing is it'll end up trapping all the leverage in the same spot, and it'll also trap retail spot in the same area. So we could see a bounce here, but I'm not super confident that it's going to lead. We've seen scenarios where it does lead to something, but there's no doubt that all retail will have the same invalidation. Keeping it pretty simple, people have actively taken trades on spot or taking leverage longs in the last week or so. There's a good chance that they've been invalidated on the move that we saw down here, this pretty nasty move down. If not, then there's a good possibility that their invalidations are down here. They might still be here as well, or here. But if we were to bounce pretty much off the previous bottom, then all of these guys would be taken out, which would mean leave the remainder here of where the invalidations are for the more active market participants. And then new market participants that will enter will be sharing the same invalidation sub 80 as well. So in my mind, in order for me to be convinced that this thing is going to be able to turn around, at least tap above, let's say 95K, 94K again, we will have to make pretty solid bullish structure in the void here. So void being the distance between this line and this line, we're kind of in free fall. Not only are we going to have to make good structure, but of course I'm going to be very stringent on the structure that I see because, look at the fucking chart, man. So we've seen instances of sort of bounce backs that come in, but they don't really lead to much. If I see something incredibly bullish, I can be more confident on it. But unfortunately, we're at the point in time where I'm going to be very critical of any kind of structure we build for the bulls at this point. Not because I want to, but that's because, the nature of the market. So there is a world where I can be optimistic again about us at least popping up some late short squeezers and then seeing how price behaves after that. But the road there is already doesn't look great. And if it starts to look better, I'm still going to be skeptical on whether or not it looks good enough. So we'll cross that bridge if we get closer to it. But as it stands right now, this is the area to look to add on to shorts if the market wants to give it to us. It's the same area I've talked about for a long time. Unfortunately, it's now flipped quite bearish. But the silver lining is, if it doesn't reject here, and we challenge the bearish structure on the top side, it means that we'd go for the high that created it. And we'd go for all these highs that come to us in middle of November, which means we can actually go for a big pop. So the fight, again, will take place here, if the market can even get up there. So pay attention here in terms of whether or not the bearish structure will hold, and whether or not we can even get up there. I'd have to see some stuff develop today and tomorrow, potentially the day after, to indicate that we can even have enough strength to go up and test this. But in terms of if we do find a rally, seems like there's some market participants who are willing to step in here. If we do find a rally, then make sure that you pay attention to 88.6 to 89.25, because that's where it challenges the structure. And the other good news is we haven't gotten low enough to where I will, to where I believe, or I will say that we've created equal lows. So that's a good sign. We're not deep enough into the water to indicate that bullish structure has become fragile, at least on the local time frame. But of course, on the higher time frame, it's pretty hard to ignore how much Bitcoin's been dumping in the last month or so. I don't have to tell you this, you've likely seen it yourself. It's pretty fucking brutal out there. And it's happening quick, which is usually in an upward trend in a bull market on Bitcoin, we will have pullbacks, but typically they're very drawn out. So like this one, for instance, it's a very drawn out process. The volatility isn't super, super big most of the time. That's usually indicative that we're still in an uptrend. But when it starts to happen, like it did here, it gets a bit spooky. And then obviously this is even more dramatic. So it is starting to look a bit more spooky in that regard, because volatility normally in crypto means that the price is actually going up. Inversely with the S&P, if you get volatility, it likely means the price is going down, right? All right, I'll come back to Bitcoin here in a second. Let's talk about the S&P. I'm gonna scrap this now. It'll be in the recordings for people that show up late, so they can... I don't think it's very useful to have all these markings on the chart without hearing the explanation behind them. But if you are getting here late, definitely pay attention to what happens at 88.6, 89.25 if the bulls can come back there. I think that'll be a huge decision point if we do see a rally. I can't really overstate it enough how important this will be, this test here for the top side, if the bulls can actually form a comeback. So if we do see a rally somewhere in this void, of course not close to the low, this will be a huge decision point as it challenges the bearish structure. And because the top side's already done, the bulls being able to win this battle here will likely lead to this arrow up here. If they can't, it'll likely lead to a new low, which could be a devastating low based off the high time frame. So biggest area to pay attention is here. I really can't overstate it enough, if we can even manage to get there. And it's possible that we will, because the S&P is doing good. All right, so the S&P has been doing quite well, gearing up for another all-time high. The VIX popped up a bit today, nothing too concerning. It was barely popped up, but sentiment still stands as bullish on the S&P 500. When we look at the VIX, there's no divergence. The structure's broken. You've got equal highs, which is no bueno. That's pretty much the only bad part about the VIX. So most of the volatility index looks good. It looks like it's on a path to eventually heading to make new lows that we haven't seen pretty much this whole year. But I guess the point that's important is that we did leave that behind, which is equal highs on the volatility index is not a good sign. But when you look at the bottom side, it looks even worse. So From a technical perspective, it looks like the S&P will make another all-time high and will likely have a lot of strength for the remainder of December. However, if that does not happen, that's a huge red flag. So when the technicals are, at least the way I look at the chart, if it looks like it's very likely that the stock market will continue to do well, and then it doesn't, that's, like I said, a huge red flag, because it goes out. It's kind of it goes out of the ebb and flow of what's to be expected in an upward trend. So it's probably good to go, but in the event that it's not, that's going to have serious ramifications on how I view it in the future. But it still looks fine right now. Obviously, it's a down day today on the S&P, but not very significantly. It's down 0.4%. The VIX up about 4%, so not really much volatility at all. Gold and silver, man. On a brighter note, gold and silver still chugging along quite nicely. Gold's looking a little bit weak here because we are testing the top, but it still looks good. Failing it here on gold would be pretty bad because we built all this structure to go for it. And so showing an imbalance of supply and demand here shows that maybe the bears are in a little bit more of control than maybe we all assumed. So if we see a failure here on gold, then the next hedge spot would be looking at the previous high, which is approximately 42.50. But if we don't, then we should be able to take out the structure on the top side and get a new all-time high on gold. So where we're at in gold right now is a decision point. But I don't know if it's a decision point that would necessarily, damage the entire structure. There is a possibility of it. Basically, on gold, you don't really want to go below 42.50 again, and it's okay if you do it a little bit, but if it's significant and we see a lot of volatility that comes in and we see this sharp arrow take place, then I don't think it's a bad spot to look to hedge against gold bets. I think it's actually a really good spot because with the way that gold was set up, the rally that we should have seen today and has already been pretty lackluster. Relatively, when you look at silver doing really good, it's kind of showing you in the price that there's maybe a little bit more supply than is to be assumed, because the structure looked good. We held it in the proper spots. But now, after doing that, right, after holding it in the proper spots, the pump's been quite lackluster. That's usually not a good sign. It's not the biggest deal unless we see a failure back below 42.50 with some haste. Seeing that would be pretty dramatic and looks good to start look to short against, or at least cover longs. But if we don't fall below it, then this arrow is still good to go. Take a quick look at copper. I can look at copper a bit later. But in even better news, look at silver go, boys. Silver's flying. It doesn't really show any signs of slowing down. Silver's been building the structure for so fucking long, has been in the shadows for so fucking long, and is finally having its time in the sun. And we're not really seeing any imbalances of supply and demand. Silver's just an absolute powerhouse. And the structure it was building was good. I mean, this was the first sign of sort of bad structure that came in here, but it was good enough. I mean, it was started to look a little bit sloppy there, but I guess it was good enough. Certainly a battle that took place of really trying to stuff the price down, but just wasn't able to do that, and as a result, we're flying on silver. I don't see any reason for this silver train to slow down. Of course, I don't try and call the top. Maybe we're at the top, but I don't try and call that. If I see a lot of volatility come in, and if I see the structure change, then maybe I can change my opinion on it. But as it stands right now, there's nothing that I can really say that would, that I believe that silver is going to come down. I mean, it can, but I'd rather catch the lower high than try and catch the absolute top. So until that happens, silver's still good to go. So during all this carnage, even today, a bit of carnage on the legacy, silver is going to be the dark horse that continues to charge forward. But yeah, it looks great so far. We'll see if it changes. I'll let you know. But so far, it looks good. The dollar now has equal lows and equal highs, but the plan for the dollar is still the same, guys. You guys probably get annoyed when I was supposed to delete this because people coming in late aren't going to understand all the markings. So let me zoom in on Bitcoin. There you go. You can watch the 1 minute action on the left while I talk about other things. But yeah, no, the plan for the dollar is still the same. You guys are probably fed up with me showing this chart because it hasn't changed in months. But that's how it is with currencies, right? At least that's how I view them. Currencies are very slow moving, so there's not really much action to take for the most part on currencies in particular. I mean, there's different trades you can take on it, but it requires a decent mastery of price action and structure. And I know a lot of people don't come in here for my lower time frame analysis on currencies, so that's why I don't do it on stream. But if you follow my methods on how to do it with, say, crypto or commodities, you can apply the same things to currencies, and they're actually really fluid. I would say that currency trading is, some people say it's harder than other trading, but I think it's actually easier. Oil's still popping up a bit, man. Look, oil can have a rally. If it doesn't get above 78 a barrel, it still looks like a big dump is on the horizon for oil. If it can get above 78 a barrel, I'll change my opinion. But until then, maybe some rallies of some sort. But ultimately, this is the plan for oil. And it could happen sooner than later, or we could get a spike. If we get a spike on oil, it's just an opportunity to short it at higher prices, because shorting it right here based off the relative structure that we built is a bit too aggressive. It becomes less aggressive if it can pop up. So even though I'm bearish on oil, I don't think it's a good area to short it just yet. Rather have it come up more before it looks good to add on to any shorts. So what I found really interesting today is that the yield is up nearly 2%. So they're going to cut the rates again, right? That's what's predicted. So why is the yield up? There's different ways to answer this question, but one thing that we can't ignore is that market participants continue to sell bonds, which makes sense, right? It makes sense that if rates are to come down, some people will want to stay locked in on them. Others are selling. So there's another instance of either lack of liquidity or lack of confidence in the United States by foreign investors. So it could be a combination of both things. I don't like to try and speculate on those kind of things. I'd rather just use the price. But it is interesting to see that regardless of trying to lock in good rates, the market is still selling off bonds. If I had to assume which one it was, I would assume that it's likely that foreign market participants are losing trust in the United States. They could be wrong to do so, but that's what I think the reality of the situation is, at least right now. Tesla's still following the plan, looks fine, actually looks quite strong. The rest of the Mag 7, I can go through it, but you guys know how it goes with the Mag 7, just up and to the right. Until the S&P starts to break down, that's going to be the case. So if you want to know where your stonks are going, get really good at analyzing this chart. If you want to know where anything's going, get really good at analyzing this chart. But more specifically, the Mag 7 is just up and to the right until volatility strikes in a major way and multiple times in a row. Yeah, I got a new mic, shiny. I liked my old mic. I was kind of stubborn with keeping it, but yeah, you got a new one. Anything on the Nifty 50? Why do you want to look at the Nifty 50 is going to follow the S&P for the most part, but generally a little bit weaker. It has been. Oh, you trade it actively. The most other indices are going to follow the U.S. indices pretty nicely. Other than the fact that think about it like this. You know how the last couple years Bitcoin has been going up, Ethereum has been going up, kinda. It's the same relationship. S&P is sort of the Bitcoin, and the European indices are sort of the Ethereum. Where if Bitcoin continues to fly, it's likely that ETH will follow. Same thing with the S&P. If the Americans are likely doing good, then the Europeans will likely follow. But still going to be a little bit less. So when it comes to European indices, I think they're a bit more fluid, but they're a little bit less bullish. I don't think there's... I'm trying to think... Or, yeah, sorry, the Indian ones. Sorry, for some reason the Nifty 50 in my head, I thought British, but it is Indian, you're right. But I think that's the rest of the update on Legacy. Let's talk about Ethereum. So it's looking pretty bad here, obviously. Ethereum has been going down pretty consistently, and we had the fight for 29. It didn't, obviously didn't hold very well. It's kind of in the same boat as Bitcoin, as we're not close enough to the previous lows here to call it equal lows, which is important. But I mean, the fact that we couldn't get much more out of Ethereum and the fact that it lost 29 is pretty bad. It's in the same boat as in we're not close enough to the equal lows to determine that it's got fragile market structure on the bottom side, but it's fucking close. And even if we do develop good structure here on ETH, I'm still going to be stringent on whether or not that structure is going to lead to something significant. It could, but I need the market to prove it to me. So because fluidity held on both ETH and Bitcoin, a little bit of a front run on ETH, which is actually not necessarily a bad thing, but the next area to look for on ETH is going to be 29.87, so pretty much 3K to look to potentially hedge again, to add on to shorts. If it can get a rally going, so if it can get up here, then the decision point, similar to Bitcoin, will be at pretty much at 3K, 29.87 to be precise. And then if bulls win this battle, it means that we'll be able to take out all of this fragile structure, which means that if this is won by the bulls, we could see something like that. If it's not won by the bulls and it's won by the bears, then we could see that. So it's another area where it's pretty straightforward where the decision point will be to determine whether or not we're going to go deep sea diving or Ethereum will make a comeback. You can see both these arrows are quite dramatic. And I'm able to do that because of how I read the structure and where I read as the decision point. It's not a guarantee that we will get a test up here and that battle will commence where we'll have an opportunity to see if we're going to see this or this. But in the event that it does, that's where the decision point will be. If we can't, then obviously it's still going to go lower. Is it like a fair value gap? No, it's not a fair value gap. It's just reading the structure. So I want to see the fluidity. Let me see if I can explain this simple. So I'll break it down as simple as I can right now as to what I look for on the structure. So Ethereum, this is going to be in retrospect right now, but eventually I'll catch you up to what's happening. Ethereum technically finds a bottom and is pumping quite nicely. Every time we make a new high here, it looks significant enough. And then this high comes in. So I'm going to mark out the previous highs, and I want you to see if you can see the difference. So let me get rid of the magnet tool. We have a high here, highs here, and then highs here, right? What do you notice about the distance between this high and this high, right? When you compare it to the distances between the previous highs. So the distance between the previous highs is more significant than that most recent one we put in. Why? Because of supply and demand. Okay, that's just a small red flag. It's not a big deal just yet. But why couldn't we get a bit more out of it? And then what happens afterwards? So we dump, make a new low is fine. That's not really a huge data point, but we dump, and then we go for it again. And where do we test? The previous high. And what happens after? So this is a bit of a front run, and it's likely due to what was happening on Bitcoin. Every once in a while on Ethereum, actually probably more frequently than I'm giving credit for. But if Bitcoin is dumping at certain spots, then Ethereum won't follow the technicals as precisely, because the market sentiment from Bitcoin, the fear that's coming in from Bitcoin, will actually affect the Ethereum chart, as most of you guys know. It does it for the fear that would come into Bitcoin affects almost every crypto chart. Ethereum is the most resistant to that effect, but it still is at mercy of that effect. So the battle takes place. If this was won by bulls, then obviously we'd get a new high and take out all the structure over here, which is a bunch of equal highs of short market participants sharing the same invalidation. But that wasn't the case. So then I look for what comes next in the structure, which was the previous one, which is here. So areas in which there was conviction on liquidity. In these scenarios where we have equal highs or just highs that are printed, each one of these structures, so I'll circle them. Each one of these structures was a couple days of price action where market participants that were shorting Ethereum, because Ethereum's been dumping like crazy, were sharing the same invalidation. So what that means is when they lose their short position, a bunch of buys hit the market and there's conviction and liquidity. Anytime we have that, I think it's important to identify for the future. Well, potentially for the future, depends on what Ethereum wants to do, but the next challenge of that structure would be at 2987, which would be here. So then the next thing I look for is what happens here. If the bulls push against the bears again, but the bears win the battle decisively again, usually it means that we're going to start crushing lows. But the silver lining is, because this is mostly done, you can argue that it was front run, but because it was front run in such a relatively tight spot based off the relative volatility, it means that there's invalidation stacking here on the front run, which is so fucking close to there that it actually just smashes it. So that's more of a complex thing. I've gone into detail about before, but I'm not going to go through it all right now because the way Bitcoin has been trading, see if I can make sense for you guys. So we look at the same thing on Bitcoin, right? So this is Ethereum and Bitcoin side by side, very similar, right? The same logic, marking out, where were the highs and how significant was the move. So we have like sort of everything that was built here. How significant was the new high that we printed here versus the one that came afterwards? You can see that this one is rather insignificant relative to the previous, which is already showing a supply overwhelming demand. And then it fails it, and then where's the retest? So the retest on Bitcoin, and I talked about this on the last stream, where to look for. You guys probably remember I had an arrow here. I didn't know it was going to be this significant, but sometimes you just get rewarded by volatility, particularly in crypto. Anyways, this holds quite decisively, wouldn't you say? I mean, it tagged it pretty much perfectly. The line, the wick went straight through the line. So at the same time, this was happening on Ethereum, which is why, even though the wick didn't go, this is kind of messy. Let me see if I can clean it up a bit. Even though the wick didn't go through the line on Ethereum, it followed the market sentiment of Bitcoin, because Bitcoin did. And there's some other nuances that go along with that. But again, like I said, I'm not going to explain it. It's a little bit more complicated, and we don't really need to see it right now. And then I look for the next spot, similar to how on Ethereum, right? Looking for the next spot. So where's the next spot? Here. And conveniently, it's shared with the previous lows here as well. So just like how I said on Ethereum, where's the decision point? Likely there. Same thing on Bitcoin. So it's testing the structure. If bulls can win this, it means that Ethereum bulls will have likely won that as well. And the bear structure will break, and we'll go for this arrow. If bears hold this, then we'll go for that arrow. And when looking at the high time frame of Bitcoin, because we're pretty zoomed in right now, for the last couple weeks of data is all that we're looking at right now, a doom arrow like this will actually challenge months and months and months of data, pretty much years of data. So it's very critical what happens here. Because not only will we get a doom arrow on what looks like a couple weeks of data, but it'll also affect the broader structure and the bull market in general. And in both these scenarios, we saw that the bears won pretty decisively. Now we need to see if they'll win the next one. If they don't, then it means that we challenge the structure here, which is rather tight relative to the previous movements. But yeah, it's how I look at structure to be able to determine what is likely to happen. And sometimes we get to certain points where not only am I able to see what's likely to happen, but I'm able to see what's likely to happen in the following weeks, and whether or not it's going to be a huge move or not. It depends. When it comes to like weeks, days, stuff like that, I don't like to time the market. Sometimes it can happen very quickly. Other times it takes time. So I can't say definitively like, oh, this will be able to tell us what's going to happen, like, for the next 2.5 weeks or something like that. Because it could happen quite quickly. Sometimes it can take a while, but at least we'll know with a pretty good probability what's likely to happen, the next big move that is likely to happen, regardless of how much time it takes or lack of time it takes. The mega alt season, as it stands right now, mega alt season is probably going to take longer. There's ways that it can happen sooner than later. But given all the action across the board, it'll probably take a lot longer before we'll see some sort of mega alt season, unless things change and I can change my opinion. But yeah, what's your view on RSI weekly on Bitcoin? Oh, like the weekly bear div and monthly bear div? I still don't rely on it that much. I think it's interesting. I showed you at the beginning of the stream where the target would be on the monthly bear div if it was to play out, but I still think it's better to read these kind of structures that form in the last couple weeks, because they don't lag as much, if that makes sense. Like if you're looking at like monthly bearish divergences, they can lag quite a bit, and sometimes they can be wrong even while lagging a while. So the opportunity is sometimes good, but it can take a long time and then not even come to fruition, so it's not very pragmatic. Whereas like reading these kind of structures on a little bit lower time frames, they don't lag as much, and they're more actionable. You can actually find opportunities on them. S&P looking bad last hour. It's not really moving too much. This is a 4 hour of the stock market. It's not really moving that much. I'm guessing that you're shorting it. Cool. Is that why you're saying that? Appreciate you on the Zcash call last week. Oh, what? Well, I showed you the bullish scenarios and the bearish scenarios, but this was the decision point. We didn't see the comeback on Zcash. So, down. Once these lows fall out, that's why I circled it. It looks kind of messy, but I circled it like a million times, because if we weren't able to regain it, then there was no path forward. It looks like Zcash is pretty dusted. You're short on it? Nice, man. Yeah, Zcash is at a point in time where we could see rallies on it, but I'm going to be very stringent and conditional on the structure that it builds. It's going to probably be a while until I can change my opinion on Zcash for right now. Yeah, it's bearish until proven otherwise. It's not to say that it can have rallies, but very conditional on those rallies, and then also what kind of structure is built afterwards, and how do I see the relationship in that structure. So I mean, we could see a pop on it or something. It's probably too late to short it, because you don't really want to just chase the red candle down, because it could pop up. But so it's kind of hands off at this point until more data comes in, referring to Zcash. The volume's still good on it though. That's still very impressive to me. But where exactly do we go next on it? It's hard for me to call that. So if you have shorts on it, man, well done. Just let it run, I guess, depending on what you want, how you want to play it. But yeah, the chart looks hard to predict right now. If something's hard to predict, I'm not just gonna fucking say, oh, it's gonna go here, it's gonna go here. I'm gonna tell you the truth that it's hard for me to tell you where it's gonna go. Nice thing with Ethereum and Bitcoin is it's pretty straightforward for me to tell you where I think it's gonna go. And the likelihood of where Bitcoin and Ethereum go is gonna have pretty big effect on Zcash as well. Although Zcash has decoupled pretty hard from the overall market sentiment these last couple months, but it still follows it to some degree. On Monero, yeah, we can look at Monero. I think people are talking about Monero because it's one of the few alts that isn't getting beaten up as badly as the rest of the alts, right? Let me catch up on the chat a little bit here. How do you play a long here on Bitcoin? Longs don't really look good. I mean, right now the only play would be to long it, but it doesn't look like a good long. You could try and get cheeky with it and play to the new meta, which is like looking for the equal lows here. But the reason why I don't like taking these is because they're not likely to lead to runners. So the implied risk reward isn't very high. The actual risk reward is pretty straightforward, but I don't really like these kind of plays. Some people will do them and adapt to the meta, but when I enter a long position, you know, I want to have it have at least the potential to run. Equal lows long is decent RR, no? I mean, yeah, it's good for the range, but I'm talking about like, you know, something that can actually run pretty far, not just in the range. And even then, you know, you can't do this if you're on a bigger account either. You can get away with it, but it gets harder to do, and it's a pain in the ass because of the risk of slippage. But like where we're at right now, if there's a gun to my head and someone told me, do I press green or red? It'd probably be green. It just doesn't look like a good one because there's not really much backing it up. I mean, even the fucking 15-minute looks like dog water, but it seems like it's probably the only thing you could do if you needed to enter a trade. I just don't think it looks like a good trade. What's up, Tom? My view is that all those billions poured into Bitcoin and Ethereum by institutions won't flow into shitcoins. Yeah, that's a reasonable take. But you also, so White Wolf, we also have to look at how much supply they actually hold. And this is important for understanding the possibility of even Bitcoin going a lot lower. Yes, institutions have been playing ball. They have been dumping money into crypto. What is the relative supply? Saylor has what, like 6%, 5? I don't know how much percent. He has like 600,000 Bitcoin, right? So I don't know, like not that much Bitcoin compared to the circulating supply. And then like BlackRock has a good amount too, right? How much? BlackRock has what, like 700,000 Bitcoin, something like that. But like if the circulating supply, or at least let's take the total supply is 21 million. And all the institutions together have like 1.5 million. Yeah, it's a very big chunk, but it's not big enough to have certain ramifications. It's a tricky dynamic, right? Because we also have to look at, you know, how many Bitcoins are on exchanges, how many wallets are just fucking dormant, and how many wallets are active or could be active. But my conclusion from all of that is it will have an effect on less rotation into altcoin. It will have a demand effect on Bitcoin. It will help Bitcoin push up higher. But most of the coins are still in the hands of the individuals. And we also have to look at the ratio of how big the market cap is of Bitcoin relative to the altcoins. As Bitcoin continues to see its market cap get a lot larger than the altcoins, then even that missing supply that is in the hands of institutions doesn't need to rotate to still get the same kind of alt season. But I still think that alt season is probably later down the road. I don't know if I explained that well enough, but it leads me to the conclusion that individual data point shouldn't have that much of a significant impact on whether or not Bitcoin holders will rotate into altcoins if and when an altcoin rally happens. And then also, it's not going to it'll have an effect on the demand of Bitcoin. I think we've all certainly seen that with how strong Bitcoin has been in the last couple of years. I think that certainly has had, the institutions certainly have had some influence on that. But once we get to a certain float, like once we get to high enough prices, active market participants will still have a pretty dramatic effect on the price action. It's the same thing we see in any financial instrument. Like the S&P, most of the S&P is just held in passive hands, right? Which is good because it's easier to go up. There's less supply, that less people selling. So, you know, With the stock market and other legacy things like gold and silver, it's most of the people that hold them just buy and hold. They don't like to sell, right? Which is good until you get to a certain price. That'll keep pushing the price up, and it has, right? But the higher you go, the harder it is to maintain it because it's more expensive to maintain it. And the more impact active market participants and fear has on volatility. And if volatility gets high enough, then some of those passive people that we were talking about, some of them might get scared as well. And once you get enough passive people to be scared at the same time, then you get every passive market participant to be scared at the same time. And that's a bear market. I'm gonna get another cup of coffee. I'll be right back. Yeah, no, it's the same dynamic, right? You can have the majority of market participants who are very buy and hold oriented. They don't like to press the red button, they only press the green button. And this is applicable to any financial instrument, from Bitcoin to Zcash to fucking S&P 500 to gold. All of that is true. It's, if volatility gets high enough, it can scare people that wouldn't normally ever have a plan to sell. If that has a big enough effect, then obviously price will go down even more, and then we could hit a downward spiral of otherwise passive market participants racing to the exit. And when that happens, will there be enough demand to catch it? And as far as the stock market is concerned, that's certainly been the case pretty much every crash we've seen since the Great Depression. Even 2008 was pretty brutal, right? But the knife was still caught. But what was the price that we paid for catching the knife? The price that we paid usually isn't realized till way later down in the cycle, which is inflation. So the question is, for everything, right, regardless of what you're looking at, how much is too much? And at what point, at what price, will active market participants have so much of an effect on the price that the volatility will be so extreme that passive market participants will start to wake up and sell? That's the question. And that question is applicable to anything that is ripping to new all-time highs or in price discovery. Can the float be maintained? It's a lot easier to maintain a float when the price is valued against dollars, that's for sure. If the price wasn't valued against dollars and it was valued against Bitcoin or gold, this chart would not look anywhere how it looks. In fact, only sophisticated market participants would succeed. But in when you have inflation, everybody's a genius when it comes to investing because everything goes up and to the right. How well can they read price and the structure? Doesn't really matter as much, because as long as they buy and hold, whatever they're buying is traded against the dollar anyways. It'll just go up. It doesn't take a genius to make money from the stock market. You just buy in and you hold it. What's the sophistication in that? So we'll see if that methodology continues to be rewarded in the future. It likely will be. I don't like to call the top, but at some point, those market participants will, get absolutely crushed. I don't think it's going to happen anytime soon, but it's impossible to know. And as the price goes higher, it's great, right? Everybody's unrealized paper gains are going up. You look at your portfolio, oh, I'm up a bunch of money. But that isn't locked in until you sell, and that's paper gains until it could keep going up though. When will this inflation rally end? That's a good question. There's different scenarios you can look at in history, even more so in recent times, like Venezuela or Zimbabwe, where the compounding effect of inflation gets too extreme, and there's no more trust in the currency. This has been happening for thousands of years, though. It's not new. It's actually the reason why gold and silver are doing so good. It's the reason why the gold chart looks like this. It's because it's been happening for long before any of the modern states have been around. My whole methodology and the reason why I've been able to survive and do quite well in the markets is because I understand all of these concepts, but I don't bet against the market. I mean, I'll short to hedge, right? I'll short to hedge, and sometimes in crypto I'll go really hard on the shorting side of things. But when it comes to like the S&P 500, I'm not a huge fan of shorting it unless you're scalping it. You know, if you train like the ES or something and you're taking scalps, whatever, that's fine. But like taking like long-term positions on shorts for American indices. I mean, look at the chart. What do you think has happened to people that have taken long-term bets that the S&P will go down? Well, the price is almost at all-time highs, so we'd have to assume that they're all underwater or gutted already. It's not to say that you can't hedge or scalp short on the futures, but the way I read it is because I've spent so many fucking hours mastering this one chart and mastering how to read its structure, I like to believe that I will, I'll at least know ahead of a lot of people when it's time to actually bet against the S&P 500. There's also part of me that doesn't want it to happen because I know even though exuberance will be punished, a lot of people who aren't exuberant will also be punished as a result. You know, just middle class, lower class people get absolutely slaughtered as well, even though they had no effect on the exuberance or the greed. So that's a part of me that doesn't want it to happen, but because I'm able to read sort of the heartbeat of the market, I'd like to believe that I'll know when the top is in, or at least have a good probability of knowing when the top is going to be in. But as it stands right now, and the way I read the structure, I don't think the top's in. It's not. There's some spooky things that have happened recently, though, that have certainly raised some alarms in my head. Which is why are we popping above 50 in such quick succession? That's irregular. That's abnormal heartbeats. And if you guys remember, I rationalized it by saying, okay, well, there was a tariff scare, right? And the tariff scare sort of maybe affected the natural ebb and flow of the market. So like, imagine you're reading like a heartbeat monitor. You have like regular heartbeats that come in, right? And then all of a sudden you have two in quick succession. That's not necessarily cause for major alarm, but if that trend was to continue, then it's starting to look like maybe it's not that healthy. And so another kick up above 50 anytime soon, pretty much in this financial quarter, if we do see another wave of volatility comes in. I mean, that's just so abnormal that it would look very close to being at the top of the stock market. But as it stands right now with the local structure that's been printed and how the market's behaved in the last couple of weeks, I don't think we'll get that abnormality that comes in. We shouldn't, based off of how I read structure. But if something is more probable to happen and it doesn't happen, it's time to pay attention. It's the same way that you would read like a Bitcoin chart or any chart. If something is very likely to happen, but it doesn't happen, then we have to reassess. And we cannot just, have confirmation bias and be like, oh, that just happened because of this, something happened over here in the world. And I did do that slightly here, right? I said that, okay, it's likely we got out of ebb and flow rhythm because of the tariffs. So maybe I did excuse this one a bit more than I should have. But the third one, I'm going to be much more conditional. If we do another kick up on volatility above 50, I'm going to be a lot more stringent. But yeah, so when we expect something to happen in the market and it doesn't happen, the worst thing we can do is try and explain it away by some sort of event that happened in the world. Unless it's like World War III. If Russia and the US started fighting, or not fighting, because they haven't, but actually declared war on each other, that would have enough ramifications to crash the market regardless of the ebb and flow. But if it's peacetime and we see the heartbeat become irregular, then it's hard to explain that away. No, I don't think, no. In short term, the local structure, and I think Tom agrees with me, the VIX looks like it's going to go make a new low, which would mean that the S&P should go make another all-time high. And if the S&P can make another all-time high, then it opens the door for all risk-on assets to do well. All alpha investments should do good in those kind of scenarios. Every time you turn your stream on, biddy goes up. Yeah, I mean, I said the only trade you could take is a long. It's not necessarily a good one, but I guess it's working out for the aggressive people. But I think it's also like the time in which I stream is usually quite favorable for Bitcoin. Do a stream marathon until we're at all-time high. Satoshi himself would have to pay me to do that. I do this shit for free, dude. I'm not gonna stream 24/7. I mean, if you give me a good enough number, I'll do it, I guess. Everybody has a price to some degree. I'll give you Gemini Pro for free if you stream more. But no, I mean, it's just another thing about where we're at currently is it's too late to short it. You have to wait for it to kick up again. Just like the short that I talked about here last stream. If you guys were here on the last stream, you can go look at the recordings. This is where I called to short it. If you don't believe me, it's posted on YouTube. But it's the same logic. Like when we were here, I said the only play was to long it, right? Eventually it did pop up, but it hit the short spot. So now the only play is to long it. But if it pops up and hits the short spot, that's the area you have to pay attention to. And in both these, this wasn't that good of a long. I told you guys it wasn't that good of a long. And this isn't that good of a long, but it's the only play that is available right now. I mean, if you're in a downtrend, longs don't look that good. That's just, it doesn't mean you can't find them. It's just they're not as solid of trades. Regardless, if we do pop it and we want to go for this fight at 88, 89, we better be ready for that fight to commence. That's where it's going to go down. We can't just rush it there. It's better to actually build it and take time to get there, but rushing it back up there is a recipe for just it getting rejected hard. This is another interesting concept. So reading these icebergs and stuff, right? We had a bunch of icebergs on the top side. They weren't that thick, but right when the dump started to commence, all the icebergs just disappear. So if we do get a pump here, all these icebergs could disappear and we could start to see a frenzy of market smashing coming in. Which is what we saw, right? I mean, look at the size of this volume node at the bottom. Right when the icebergs disappear, a huge red volume node comes in here at the bottom. So once these icebergs disappear, we could see a huge green volume node, and then we go for the ultimate test. I mean, I should say ultimate test is relative because we've already failed the 89K test. That's already no bueno. That's really bad. In terms of like road to recovery and rebuilding structure and all that jazz, there's ways to do it, but again, I'm going to be stringent and conditional on it, and the first thing I need to see is what happens here. It's not a guarantee short, by the way. Even though this short worked out nicely, and some of the other ones I talked about on stream also worked out nicely, it doesn't mean that it's going to be guaranteed to work. So don't fucking go all in short. You know, still use good risk management. No, I know that, Power. It is just interesting because most of the times that I do stream, the price starts to rally a bit. There's been a couple instances where we were at certain bearish spots that it's actually dumped when I've been streaming, but I get that sentiment of like, oh, Urban's online. Looks like the fucking Bitcoin's gonna start to go up again. I understand that because it's happened a lot. Okay, pretty nice hold on the local structure. I mean, it's sloppy as fuck, but it's still good enough. It's the same kind of scenario we saw in the past. Good enough for a pop, really bad if it drops. Sometimes you want good enough for a pop where it's not really bad if it drops, but that's not the scenario we're seeing right now, so let's pump it. SR flip on equal highs, yeah. I mean, look at the Tom, the bearish fluidity is certainly pretty fucking scary, right? Call Boganoff. Ooh, that was really zoomed in. So as far as like where liquidity is resting, you know, people are getting a little bit more. How do I put this? People are getting a little bit more safer when it comes to opening leverage positions at this time. The market is a bit scarred right now, so a lot of the new positions that are being opened have really loose invalidations. So, I mean, obviously, fear is very high and greed's very low, but you can also see it in the heat maps, where market participants will still speculate. They always will, but they're giving their positions a lot more breathing room. So, what that shows to me is that there's a lot of conviction in long-term price analysis. So, whether people are bullish or bearish, they're unsure of where it'll go in the short term, but they're getting more confident on their analysis of where it'll go in the long term. So we saw this actually in the Twitch chat the last couple of weeks of how polarized everybody was, right? People are very bearish or very bullish. I don't think that trend is going to stop anytime soon. We'll continue to see the polarization, where those that are confident in their analysis will be more confident than ever, which is a recipe for volatility, because although the invalidations are further away, it also means that spreads will widen. This is actually a very profitable time to be a market maker, because of the emotions in the market. It's funny enough, Binance wiped out all the small time and medium time market makers just in time for the big time market makers to start gutting everything. Makes you wonder what kind of deals are being had behind closed doors. You know, big time market makers are and Binance are buddy buddy, right? Because they both make a fortune working together. So who knows what kind of deals are being done behind closed doors, but I can see certain things happening that they can't hide, and I can lead to certain conclusions. I can't be certain about them, but things that they can't hide. Just like the same thing with price. Allow me to sort of reverse engineer what the fuck's going on. It's just harder to do it, right? It's harder to do it when you don't know what kind of deals are being taken place, but or you know, what's happening. You can have an idea of what's happening on OTC, but there's so many different, you know, and so that's why I emphasize understanding the price action so much, because it can't lie. There's no hiding in the price. As a retail market participant, it's your best friend because it can't lie to you. And if you can get good enough at reading it, it'll tell you where it's going to go, from a probability standpoint. Not a certainty, for sure. They're rigging it up? Yeah. I mean, that's not new, right? But I don't care if it's rigged, because it just makes it easier to predict. Sometimes it can be frustrating, right? But at the end of the day, if it wasn't manipulated, then it would be random and there would be no opportunity. Or there would be, but it would be betting that the dollar will go down in value, which is what a lot of people do. Yeah, like most wealth managers, funds, have just been very rewarded, whether they'd like to admit it or not, by the fact of inflation exists. If inflation didn't exist, there would be very few successful funds out there. Very few. In fact, hedge funds would actually be doing a lot better. As you guys know, most hedge funds don't beat the S&P, but if inflation wasn't a thing, I'd actually think it'd be flip-flopped. I think the average buy and hold guy would be the one getting fucked, and the sophisticated active market participant would be running circles around him. When you get burned 100 times, it makes sense. Yeah, I mean, I certainly wouldn't have the capabilities I do have if all I did was win every trade. That's for sure. If every trade I took was a winner, I wouldn't care to be so obsessed and spend so many hours, doing what I do. So it's a blessing and a curse. Obviously, it's much nicer when everything is just all sunshine and rainbows all the time, but there's no beauty in that. I guess the beauty comes from the fact that it goes up and down, not just up. It's less fun, but I guess it depends on your definition of fun. Yeah, thin books, exactly, Tom. Although liquidity looks fine in Bitcoin, thinner books, bigger spreads, more to farm for the market maker. And this is something we saw in October as well, right? With the crash that came in October. Wipe out all competitors of the market making scene. So small time and medium time market makers that were doing quite well probably had better models. I think we're probably unfairly wiped out by Binance going down and not allowing to reduce positions. You cannot have an exchange or a brokerage that does not allow reducing positions at 24. Crypto's 24/7, so you need it 24/7. You should always, no matter what, be able to reduce. If there's ever a moment in time where you cannot reduce, you can absolutely destroy all competition. And also a lot of confidence in crypto in general. Now, they can argue that they got hacked, or they can argue that their systems failed, or whatever. But I'm not buying that 100%. Maybe it's true, maybe it's not, but the fact that they just wiped all the competition off because of something that quote-unquote happened. It's the same thing that happened in silver recently too, right? What we saw in silver. Oh, it's a cooling issue. Some computer needed to, I forget what their logic was, but like something needed to cool down or something. It's like, come on, man, really? What happened with silver? They shut down the futures trading for silver right before it was breaking out, like right as it was breaking out for all-time highs. I imagine that there was a lot of offers and no quotes. Market makers were panicking, and one of the things had a cooling issue, I guess. But one of the beauties about silver is, and one of the beauties about the market, is sometimes you can try your best to manipulate it, but the conviction is just so overwhelming that the second you turn this shit back on, what was going to happen will happen. You can try and fight it with manipulation, and sometimes that'll work depending on the size of the market cap, the amount of market participants. But something as big as silver, it's not going to fly. Silver had overwhelming demand. You cannot stop that as much as you want to. It's basically like, trying to change the rules because you're losing. And then you change the rules and you still lose. Because you were never meant to win. Now, sometimes you can change the rules and still win, but not with something like silver. If anything, the manipulation that might have taken place between the big time market makers and Binance, they should feel a responsibility and obligation to actually lean more bullish, because they've spooked the fuck out of passive market participants in crypto. I'm sure there's some people in here that are watching right now that are just passive investors in Bitcoin, buy and hold, and they're wondering if they should sell. So when that happens, if enough of them do that, then it'll wake up even more passive market participants, and then you hit a downward spiral. which, like I said earlier, is a bear market. Come on, Biddy. Maybe I'm too generous in assuming other people's will act in good faith, but it's usually the end result anyways. Usually good faith wins in the end. The in-between can get kind of messy though. That's not an argument when you're a custodian for billions. What are you talking about? What did I say? That's not an argument when you're a custodian for billions? People don't want regulations, but they also complain when sketchy things happen. Oh yeah, no, I, not necessarily libertarian, but I believe that let the free market have at it, right? Because, like I said earlier, you can change the rules and you can still lose. Binance not being able to execute orders. I'm sure Binance was able to execute orders. I'm talking about like 7-figure, 8-figure, even 9-figure market makers were not able to reduce positions because they were arbitraging between, and this is pretty common practice, but arbitraging between the spot and the derivatives, the perpetuals. Now, I don't think their models were built very well because they should have been built around isolated if they were capable of doing that, not cross. But using cross is like classic arbitrage. That's like legacy way to do it. I think this really shows the value of isolated leverage. Because with isolated leverage, it levels the playing field. With isolated leverage, you can still survive even when Binance tries to pull shady shit. Like I said before, man, Arthur Hayes, probably not good that he introduced 100x leverage when Bitcoin volatility was like 5-10% moves every single day. Nowadays, it's fine to have 100x, but he did, and Ben Delo introduced isolated liquidations, which, I mean, they have to compete. They have to give you isolated leverage because of what he did. So that's the silver lining of BitMEX. Obviously, the bad side of BitMEX is a lot of people who didn't manage risk properly got absolutely fucked. But I think it's vastly underestimated the importance of isolated leverage. Cross is bait, yeah, but if you assume that Binance will never put you in a position where you cannot reduce positions, then cross is fine. But if you've been in crypto long enough and you've seen all the shit that's gone on, I mean, you'd be hesitant to use cross leverage. I don't know, man. These are complex topics that probably most people in the chat don't really give a fuck about. But if you trade perpetuals, you should care about this kind of stuff because there's levels to the game, and this is one of the deeper levels. So the next rise up of 7, 8, 9-figure market makers, hopefully they've learned their lesson. And the next rise up will have isolated, and so even when they change the rules, they can't win. With cross, you can open an equal position in the other direction and never get liquidated. Yeah, then it comes down to funding, right? But it's just, at its core, a lot of it is just taking advantage of the spread and then using arbitrage. A lot of people are believers that that's the only way to make money in the market as a trader. But I don't agree with that. Directional based stuff, I mean, I've showed you guys a million times of where I think the price is going to go next. And of course, I've been wrong a handful of times, but I've been doing it for a while. I know other people that do it. It's possible. It's just a lot fucking harder, but it's more money to be made. Or at least more percentage gain to be made. So to put that in simple terms, instead of betting on both sides of the market 100%, just delta neutral, you don't care where it goes, you're just going to try and make a little bit of money off of providing liquidity on both sides of the market. actually taking a stance on where it's going to go next, and taking an even bigger portion of the pie if you're correct. Yeah, liquidity is still pretty thin. It's not bad, but still a little bit thin. What's the S&P doing? S&P should be closing pretty soon. Oh, it's dipping, that's why. Okay. Cross-exchange arbitrage. Yeah, that happens all the time too. Most market makers will have liquid on all the big exchanges at the same time. That's why sometimes, you know, when you see like a wave of green come in or a wave of red come in, it'll be a bunch of different like logos next to it, right? It's the same person doing it, just on on multiple exchanges. Now when a flood comes in, it's just it's a bunch of different people. Next time you see a wave come in on the orders, you're going to see different logos behind them, but it's the same entity. Usually. Not always, but that's typically how it is. But yeah, man, if you want to get good at knowing where the price is likely to go next, the beginning of this VOD, I went through how to look at structure probably in a more detailed, simple way that I have in the past. When I was showing you Bitcoin and Ethereum side by side on the 4 hour and showing you what I look for, with today's meta and how the markets are working they're actually quite efficient, but it's understanding that, I would say, is almost paramount. Because I've tried to learn everything else for the most part, or at least not everything else, but most of the stuff that's out there over the years. And it's just no good, in my opinion. Some of it might be, and some people might find success, and more power to them, but most methods out there, if you're not analyzing structure, then you're gonna have a hard time. Unless you're doing like really high time frame stuff, which would just net you not that many opportunities. And then you can even, what I showed you on the 4 hour, you can take it down to the 1 minute and stuff, but you need to have all the context of everything moving. All the moving parts together. That's why it's always important to start with the higher time frames. Let's look at a Bitcoin monthly chart together. Looks pretty good, right? When you zoom out like that, doesn't look too bad. But you start here, and then you work your way down. The reason why I don't start here every stream is because, I mean, the monthly chart doesn't change that often. You know, maybe once every couple months you can look at it and see how much it's changed. But if you're looking at something new that you never looked at before, this is where you should start. And then weekly. This is what the weekly chart looks like. When I say weekly chart, I don't mean 1 week. I mean every single candle is representing a week of data for the people that are new. And then daily, and then 4 hour. And then by the time you get to the 4 hour, you should have a pretty good idea of where it's going to go next. And then once you have a good idea of where it's going to go next, by the time you're on the 4 hour, then you can go to the lower time frame to use to step outside of theory and move into practice, which is taking trades. You could take trades just based off the 4 hour, though. It's not that bad of a strategy. In fact, that's probably what I'd recommend for new people, is to don't go lower than the 4 hour to take a trade if you're new. If you're more experienced, then you can dip lower. You know, the 1 hour is okay. The two big time frames I think that are important for trading is the 4 hour and the 15 minute. But there's good stuff outside the 4 hour and the 15 minute. Like, it's pretty dramatic to go from like 4 hour to 15 minute. So you could throw like the hourly in there as well. Although I don't think most tools that you could use to analyze on the hourly are very good. But it's like a good little transition to go from 4 hour to 15. And then if you're really good, you go down to the 3 minute or the 1 minute. You don't really need the 5 minute. The 5 minute's okay, but it's similar to the hourly. It's good, but it's not that good. So like most important would be like 4 hour into 15 minute into 3 minute or 1 minute, 3 minute, 1 minute, kind of same thing. And then you can throw in some other ones in there, like a 5 minute or an hourly. Aren't too bad, but just understand like how valuable they really are. And at the end of the day, a 5 minute chart isn't going to look that much different than a 3 minute chart, right? I mean, these look pretty fucking similar. You should still be able to identify where the important level is anyways. The use case of going down to these lower time frames is to scalp, right? And I've talked about this concept before, but I think it's really important is if you do want to scalp, and you want to take trades fast, and you want to do like, we want to scalp, right? Most people are going to get they're going to get their head cut off. One of the biggest things that you can do if you want to, play in this field of scalping 1 minute perpetuals is you have to fucking yield to the high time frame. You have to. I mean, maybe there's people out there that don't need to do that, but I would be very skeptical of them. If the first thing they do is hop on the 1 minute chart and they're like, okay, well, there's a fair value gap here, so and there's, order block here and that kind of stuff. There's no way, dude. You're gonna get absolutely slaughtered. And then the other concept is understanding how to not just binary trade. You could do this stuff, right? Like fair value gap, order block, full in, full out. I'm going to take all the profit at the same time type stuff, but that's like being in the top 1% of the top 1%. And probably even more dramatic than that. It's probably the top 1% of the top 1% of the top. Like it's really fucking difficult. And it plays on your emotions incredibly hard. So understand that if you do want to do that, right? And you want to be good, and you want to be in the top 1% of the 1%, there's a huge concept that is never talked about in retail trading, because I don't think most people fucking understand it, and I've tried to explain this in previous streams, right? If you understand where it's likely to go in the high time frame, then you don't need to binary trade. What is binary trading? It's saying, okay, I'm going to take a trade here, I'm going to take profit here, and I'm going to put my stop loss here, which means like if it gets to here, right? So like say you entered here. If it gets to here, I'm closing 100% of the position. I'm full out of the trade. The reason why this is bad is because if the high time frame says that it's bullish, you should not be closing the entire position. Because let's say that we do go up and test up here. I don't know what it'll look like on the way up, because charting on the 1 minute candle is really fucking difficult. It's pretty random. But let's say that the high time frame plan is to go all the way up there. Well, how much risk reward have you left on the table? So in this case, you're full out for 5, which is actually rather good. But what if the last 20% is 30? What if what you're truly going for is this, but you don't know it? And in this scenario, it's not bad, right? Because I'm showing you a theoretical example of the trade working out. But how many times are you going to take a 1 minute trade like this, and it's going to go like this? How many times are you going to take a 1 minute scalp, and it's going to do that? If you trade it enough, you know that this will happen very fucking often. Probably so often to the point where when it doesn't happen, you're still not profitable. It's because, whether you realize it or not, you've left all this on the table. And you're truly going for a bigger trade than you realize, and you're cutting your winner short. It might not look like you're cutting your winner short because you're locking in 5 risk reward. But if you don't understand the high time frame context, then that's what you're doing. That's why so many people will fail doing this. And, like trading influencers or whatever you want to call it, will only show you when the trade works. And let's say you go practice it on your own, this is going to happen to you so many fucking times. So if you do want to scalp the 1 minute, the 3 minute, whatever you want to scalp, You have to understand that your win rate's going to be extremely low. And you also have to understand that cutting a winner early, while it doesn't seem like it's detrimental, because you've locked in money, will have you die by 1,000 paper cuts. And if you're going to do that, right, and if you're gonna scalp and go for bigger trades, you have to get comfortable with the idea of risk management, because this will happen to you. You will get stopped out that many times sometimes, particularly if you're not as advanced at understanding market structure and price action. If you're using like fair value gaps and order blocks and all that jazz, this is probably gonna be your future. Probably already has happened. In that case, you should watch the high time frame. Exactly, that's my point, is you should watch the high time frame. It doesn't mean that you can't scalp, but you should understand what your target is. Because risk reward is calculated how? It's the relationship between your stop loss and your take profit. That's risk reward. So you can have a good stop loss. You have a bad target. You'll probably float along for a while, but you might not ever make it. I'm not saying this stuff to be an asshole. I'm trying to fucking show you what most people don't understand, or if they do understand it, they don't fucking put it on the internet. No one talks about what I call it implied risk reward. I kind of took that term from poker a little bit. But that's how a lot of people understand this concept that are successful traders, but there's not like, basically the way that you would define it outside of the proper terminology would just be like non-binary trading. Or some people will call it like grid trading, but having multiple profit targets. And if you're betting on the long side of the market in good conditions, having a runner that only gets closed via stop loss and profit. You can do it on the short side too if you're interested in farming funding, and based off your calculations, the funding, it makes it worth it, and you have a very high conviction that we'll be in a bear market for like a year or something. Like Youth, I think you're one of the people that grabbed the absolute top, right? You're still farming funding. So when we were here, Youth was like, all right, boys, grab your shorts. It's time to farm funding for a year. I think you probably still have this open, right, Youth? At least some of it open, just farming funding. And it's a tiny position as his runner. Exactly, right? It's a tiny position, but if you farm funding on it for 12 months, then it's still pretty advantageous. Yeah, algo trading, and trying to be a quant and all that jazz. Good luck, man. You might find success. I mean, the best of the best might find success for a year, maybe a couple years, but eventually it won't work anymore. And I think one of the main reasons of that is because you're not truly understanding what you're doing. You have to actually understand why the price moves the way it does, instead of just back testing your way through it and letting a computer figure it out. Like, why does the price move the way it moves? So that the fewest amount of people can make the most amount of money. The market is fucking brutal, dude. It's max pain. That's like, as dumbed down as I can make it, where is the most painful spot for the price to move? Where do the most amount of people get fucked at the same time? That's usually where the price will go. So if you can get good at identifying that, you could take advantage of it. And why does it behave like that? The reason why is because, let's take like a simple structure, right? Price makes a high, price makes a low. Price makes a lower high, price makes kind of like an equal low. It doesn't have to be picture perfect equal low, but based off the relative volatility, you can determine that it's an equal low. It does it again. Okay, so now price is sitting here. You have two sides, right? You have the sellers and the buyers, or the short sellers and the longs. Okay? So the people that are betting against the market could have done that from up here. They could have done that from up here. They could have done that from up here. The people that are betting for the market are all in the same spot. So the last one to cut the long and profit will be the rotten egg. Actually, in most cases, it's like 95% of people will be the rotten egg. But if price is sitting here, put yourself in the head of somebody who's shorting it, somebody who's longing it. So try and put yourself in their head. What do you think these guys are thinking? Oh shit, I really hope the price doesn't move against me. What do you think these guys are thinking? Oh shit, I really hope the price doesn't move against me. They're both thinking that. But where is more of the clustered thinking in the same spot? So both sides are thinking to themselves, I really hope this trade works out. I hope it doesn't move against me. What if it moves against me? Should I close the position? It might move against me. I should take profit here. That's the logic that's going through their head. So if more people are scared on one side, it'll naturally bring the price there. Which side is more scared and where are they more clustered? It doesn't always work like this because there's more context. Like what basically the question that you should ask me is, what time frame are we looking at? Is this a 1 minute or is this a daily? And what happened in the past over here to the left? What are we looking at over on the left as well? So in a vacuum, this is simple. There's more context that goes into it though. Time frame and what happened over here to the left that we don't know. But if we're just looking at a vacuum, and let's say everything on the left says that, oh, price is going to go down. And this is a high time frame chart. If all the context says price is going to go down, and we're on a high time frame chart, and then this structure says we're going to go down, where do you think we're going to fucking go? The higher likelihood, in fact, if all the context is pointing towards down, is down. It's not a guarantee though. Price could do this. And that's why you can't bet everything on the trade. It's just about finding what the probabilistic thing, where it's going to go next because of how many people are going to get scared at the same time. And you could flip it around too. Say this, it looks like this. Well, everybody who's betting against the market, well, the price is right here, is thinking, oh, should I take profit? Should I take profit? What if it stops me out? And these people are thinking the same thing, but price is much further from these guys. Price is much further from these guys. Price is pretty close to these guys as it is to these guys. When a trade is working in your favor in a big way, you're way less stressed, right? When a trade is hovering next to your entry, you're much more scared. And so when the price is hovering on the entry of a lot of traders, the last one to close, it's a rotten egg, right? If the trade is well into profit and your stop loss is in profit, you're sleeping like a baby. When it's the inverse of that, you're sweating bullets. And so we must understand what the crowd is thinking. It's not about what you're thinking. What you're thinking can only get you fucked in a lot of cases because you'll have bias. Try and figure out what the most amount of people are thinking. That's all the market is. It's crowd psychology, people pressing the red or the green button. Now, there's another factor which I've talked about in length, which is inflation, right? If something's being traded, against the dollar and the dollar's becoming less scarce because they're printing more of it, then naturally the market will lean to the up and to the right. But after you go up and to the right so much because of exuberance, and it's working, let's just keep buying, it's working, let's lever up even higher. Then even with inflation, you can still have a downward move. So there's a lot of moving parts, but at the core, all it is red or green button. People want to overcomplicate it because overcomplicating, seems better. That's just how humans are, right? We like to overcomplicate things. Everybody fucking does it. When you were in school, you probably overcomplicated things when you didn't need to. Everybody does it to some degree. So whereas the real skill is in simplifying it. when you look at a chart, try and remove your bias. Like, what are you looking at the S&P right now? And by the way, this is a 1 minute chart, so the probability of it working out is not super high. But even on the S&P, of course, this isn't a futures chart. We'd have to look at the ES, but let's imagine it is. People that are betting against the market, where are they? People that are betting for the market, where are they? So it's this. Now, is it guaranteed to work out? No, it's not guaranteed to work out. It could easily continue to dump. We're on a 1 minute candle. But understanding the structure of like where market participants will capitulate at the same time, or who's under more stress. Is it the red side or the green side? Then you can join the winning side when you need to make money. Like I said, this is a 1 minute candle. There's no guarantee that's going to work out, but it's the logic, right? And we're not even looking at the futures chart. We're looking at the fucking spot chart. Now it's going to dump. It's going to dump and you guys are going to think everything I just said was useless. I'll be right back. I'm going to grab another cup of coffee. I can show you some examples of this happening in Bitcoin over the years. Because this, again, pain is one of the best teachers, right? I wouldn't really understand all the things I understand unless I went through a lot of pain. I know that sounds cringy, but that's the truth, and you could probably find that applicable in other areas of your life outside of trading as well. But one of the times in price action that really taught me this lesson was I had a pretty big bet. This was back in 2018. I had a pretty big bet that we were going to do this on Bitcoin. And it's because I didn't really... I had a decent understanding of how the market worked, but from more of the algo mind instead of the crowd psychology mind. So this is a clear-cut example of what I showed you, right? Where do you think all the people are sweating on the bottom side? Where do you think the top side is at? Okay, so this is in retrospect, right? So it's not... People will just, comment on the fact that it's in retrospect. Oh, this guy's just looking at previous charts or whatever. If you're new here and that's what you think, the recordings are on YouTube of where I told you to short last stream. You can see if I was right or wrong about that. Anyway, I was wrong about the long, but as short I was right. Is that how you lost your house? Yeah, I'm in a cardboard box right now. You remember that? Yeah, this was fucking brutal, right? Because this is what the context of this, by the way. This was back in 2018, right? This is when perpetual contracts and leverage really started to become popular in crypto. So leverage wasn't really that popular in crypto until around this time. And so people now could take out loans on their money and long Bitcoin, with high leverage. So this crushed a lot of souls on this move. I know it wasn't the only one that got crushed here. But the example is, where do you think everybody was sweating, me included? And where do you think most people would have their invalidations for leverage, or where do you think spot people would give up? Here's what I didn't know. If the price was so bullish here, why couldn't we, make new highs over here or something? Why did every time we went for it, we couldn't get higher? By the way, this is the same thing I used to call the dip on oil recently. Well, not that recently, but some of you guys are probably here because I called the crash on oil. It's the same logic, though. Okay, so let's look at it again, right? What happened after? Same thing, but see if you can see it from the other side. This is it flipped on its head. So if you can't see it, if I do that, can you see it? I've now inverted the chart. Okay, let's look at it again. Now, it's not always going to be this clean. In fact, these kind of structures are almost a blessing because they're very straightforward and they don't always pop up like this. Sometimes it gets messier and complicated, but the more experience you have reading it, the better you can see the complicated stuff and the more messy stuff. Which is why, for the most part, when most people don't know where the fuck Bitcoin's going, I have a general idea because I can sort of... It gets harder, right? And the harder it is, the less confident I am, which is natural. And there's different sort of things that you see. You don't always just see this. You can call it a pattern, whatever you want to call it. You don't really see the structure all the time. Sometimes you do. Like, we didn't really see it again for a while. But, I mean, I can't teach you everything in one stream. I can show you different scenarios besides this one, though. I've talked about different ones before. But this one is pretty rare, and when it does happen, it's pretty straightforward, right? It's a bit easier to get good at recognizing, right? It's the same reason why I said Tesla was bearish here. Like, I didn't use anything fancy or anything complex to be bearish on Tesla here. I just saw the same thing again. That's all. I saw the same thing. The reason why I was bearish on oil is I saw the same thing. Oh god, the oil chart's gonna be so messy. But yeah, look, it's not working on the 1 minute, therefore it just doesn't work. Let me show you the oil one. This one is gonna look really obvious in retrospect, right? The oil one was really straightforward. That's all I did. But yeah, this is a good example of it not working on the 1 minute. It doesn't always work on the lower time frames. If this had high time frame confluence and the same structure was built on the high time frame and on the low time frame, then so I'm actually kind of happy it didn't work right here because this shows you that it doesn't always work, particularly on the lower time frame. And if you're new here, you're probably thinking, oh, this guy's just going and nitpicking things that have already happened and then, you know, claiming what happened already happened. Yeah, that's true, but I did talk about all these things before they happened. I don't know why I feel the need to defend myself, but I think it's just in part of human nature, right? I think it's just part of human nature to... I don't know. Anyways, what do you see on oil right now? Is this not the same thing that's transpiring? So until we get a high higher than this high, then the plan is the doom arrow on oil. Now that doesn't mean that we can't kick up, and if we do kick up, that would be where the opportunity is. Build the same thing. And so this is another important concept in trading. So we've identified that oil looks bearish, right? Right now oil looks bearish. But where is it sitting? It's sitting at the relative lows. So even if it looks bearish and it's more likely to dump, is it good to short it right here? You have a pretty strong inclination of where it's going to go next, right? It'll likely dump. Does that mean it's good to short it there, though? It depends on how wide your invalidations are and how confident you are in your analysis, but I would argue no. Even if you think something's going to dump, right? Is it a good area to short it? Well, it depends. Where is it sitting? So, like for instance here on oil, if it did kick up, then it looks good to short it. Because you have better risk reward. But what if it never kicks up and it just dumps? And you were right about it, right? You were right about it being bearish. But you never got the trade. What is the negative of that? The negative of that would be you would interpret that you've missed out on an opportunity. I would argue that there was no opportunity there. And you didn't lose any money. I use the analogy of like, by the way, the S&P is going to close soon, just in time for it not to work out what I was talking about. The analogy I use is leaning towards poker, but Buffett talks about it in like a baseball term, which is probably more popular at baseball than poker. I don't know. I haven't really looked, but you can't, I think the way he describes it is you can't strike out, right? You can, or sorry, you can only strike out if you swing at the ball. So if you swing at the ball, you can strike out. But if you never swing, you can't strike out. So even if they throw a fastball right down the middle, but you don't swing, it doesn't count as a strike. It's only after you've swung at the ball that it counts as a strike, even if it's in the if it's in the box, right? Even if they throw a fastball right down the middle, dead center of the box, it's still technically not a strike, because you can always wait for the best pitch. And the poker analogy I use is there's no big blind, there's no small blind, there's no ante. You don't have to play pocket jacks. You don't have to play ace king because there's no big blind. Imagine playing at a poker table, right? And this is a really kind of boring way. Poker would be so boring if this was the case, but you're sitting down at a poker table. It's very high stakes, right? Let's say you bought in for all of the money you have. But we're gonna play a game where there's no big blind and there's no small blind and there's no ante, which means that you can fold as much as you want without risking any money. Well, what would be the optimal way to play that game? The optimal way to play that game would be only put money in the middle if you have the best possible hand, which in poker, if you don't know, is two aces. It's called pocket aces. If you were playing a game like that, why would you ever put money at risk unless you have pocket aces? Why would you ever swing at the baseball unless you have a perfect opportunity for a grand slam? Because if they throw it down the middle, right in the middle of the box, it doesn't count as a strike unless you swing. So bringing this back to trading, you could be confident that oil's going to dump. But what if it pops up before it dumps? And you get knocked out of your short position before it dumps? That's why execution is so important. No one is forcing you to buy or sell. Unless your brokerage or exchange is like, oh, you can't have inactivity for this long or you're going to have to pay a fee, which is bullshit. That shouldn't be a thing. But the only clock you're racing against is inflation. That's it. And while it is high, it doesn't just, jump up overnight. Well, it kind of seems like it these days. James Button got his nuts kicked for playing poker. I'm never touching this. Yeah, I'm not. I'm trying to think of other analogies that maybe be more popular, but sports and poker seem to be the easiest to draw. I don't know how many people even know how poker works or even know how baseball works, but I'm trying to find analogies that would help you understand that no one is forcing you to press any buttons. So sit on your fucking hands until you have an opportunity that you can't fucking ignore. You don't always have perfect conditions. We didn't get any sweeps on the way down. That's not true. But what about this one? I talked about this the last time I streamed. It's on YouTube. I think it's the most recent YouTube video on my channel is this one right here. There's still opportunities. They don't happen as frequently, right? I also talked about this one as well. And then looking for this as well. Obviously I agree with you. There's not that many opportunities. In this circumstance, there's only really 2 or 3 that happened in the last 30 days. So yeah, 2 or 3 opportunities to hit a monster short in the last month kind of sucks. But if you get really good and you get really cheeky with it, you can find more than 2 or 3. It's just the probabilities of those working out aren't as high. So based on your expertise, would you open a short position before the break of structure? Generally, no, but it depends on the context. What is the really high time frame trend? How do you analyze that? If you think we're in a bear market, right, and you have a lot of reasons to believe that, then you can get cheekier with it, I guess. But just understand that trying to be more aggressive like that, there's going to be plenty of times where the price knocks out your short position before the price goes lower. It wasn't a clean sweep. It left behind liquidations. Which one? Both of these examples, they were clean sweeps in my opinion. This is pretty much knocks out a lot of the short positions. This knocks out a lot of the short positions. If you're talking about what, like, more locally, like on like the 15-minute or something, yeah, it's possible it'll happen. I mean, you just saw it on the S&P 1-minute chart, right? Like, I tried to illustrate it for you, but it didn't work out on the 1-minute chart on the S&P because, you know, low time frame, sure, you're gonna have equal lows that hold, equal highs that hold, and it can be frustrating, but it's part of the market. It wasn't as common as it is nowadays. I'll give you that. Like 5-6 years ago, equal lows, equal highs were not necessarily a thing. They would get swept all the fucking time, which is why I think lower time frame RSI divergences worked more frequently. But, you know, the dynamics of how the price moves, that sort of meta does change, right? There are certain truths that sort of hold throughout different metas, and you can either adapt to how the meta is changing, or if you have strong enough principles, then you would still be fine, right? But you would have less opportunities, which is what I think you're pointing at, right? There's less opportunities to get the to add on to short positions on the way down. I see that point. It's true, right? We went down pretty quick. It's not like there was that good of an ebb and flow. Like if you look at the daily, like we went down pretty quick. Like why wasn't there an more of an ebb and flow sort of thing? But if there was more of an ebb and flow, the chart would actually look more bullish too. Not just because we went down quicker, but also how it affects the structure. All right, for those boys that took the aggressive long, looks like Bitcoin's still working out here. We'll see. I mean, the way that low time frame stuff is going to work more frequently is if you understand the high time frame buys. That's just, I know I say that a lot, but it's very important. And let's say that you didn't take this one here, right? Then you would just look for the next one, which would be here. Right there. Obviously this one's a little bit lower probability, but it's still the next one to look at. What is considered high time frame? That's a good question because time frame is all relative, right? What is high time frame? What is low time frame? If you've never looked at the financial instrument in the past, I would say, and it's been around for a while, start with the monthly, then work your way down to the weekly, then the daily, then the 4-hour. And then after the 4-hour, it's in your hands of whether you want to swing or if you want to scalp. If you want to scalp, then you go down 15-minute, 3-minute, that kind of stuff. If you just want to swing, then 4 hours, pretty much where you call it. If you've looked at the financial instrument a lot, like let's say you're looking at a Bitcoin chart, you might feel like you understand the high time frame really well and you don't need to look at it because you've looked at it so many times. It does change, right? It's still good to look at it. Like let's say yesterday you looked at the 4-hour chart on Bitcoin and you start today and you don't look at the 4-hour because you assume, you assume that, oh, I know what it looks like. I looked at it yesterday. The 4-hour, arguably whatever you're trading, you should look at it every day because these little things that happen on the low time frame do influence the high time frame. Particularly if there's a lot of greedy, cheeky stuff happening on the low time frame, that will have serious ramifications on the high time frame if it keeps happening. If it happens repeatedly, then it'll certainly have an effect on it. So you have to look at it. But yeah, I mean, top-down analysis, start as the highest. Try and see the whole picture first. And then work your way down. Anything higher than the 1 second is higher time frame. Yeah, you need the 1 second chart. But another important thing is like understanding your bias and the ebbs and flows, right? So let's say you're bearish on Bitcoin, which arguably could be the right approach right now. Bitcoin looks pretty bad right now. You still want to wait for greedy bulls to pop up the price and greedy bears to prop up the price, because what a greedy bear is someone who gets squeezed out of their short position before the price actually dumps. And if you have enough of them in the same spot, you just wait for them to get wiped out, and then like this on Bitcoin, right? Everybody is shorting this, right? Invalidations at the highs. Pop them, and then if you don't see that afterwards, or at least something more significant than the previous one, like if we just look at the previous one, I don't really like. A lot of this is just by experience and being able to read the chart, but if you wanted to find a way to quantify it, like how much did we go up from this high to this high, right? How much did we go up from this high to this high? I do it more based off experience, but I get that people don't have the same amount of experience, so if you wanted to try and nail it down by certain, quantify it certain ways. But like, why wasn't this more significant? Like, why couldn't it at least be like this? Maybe this arrow is asking for a lot. Why couldn't we at least do this? Well, obviously there wasn't enough demand, right? In the most simple terms, there wasn't enough demand to match the supply. And why does a move like this even happen? Well, if everybody's shorting it here, and then the price goes above it, you can call it a push to fill, whatever you want to call it. But if the price goes above it, then we get a flood of market buys on derivatives, arbitrage bots on spot adjust. So, certain liquidity provision models adjust, and it props up spot prices, but it's not a genuine prop up of spot prices, because it was originally happened because of the derivative markets. So if you are taking a perpetual trade on Bitcoin, you're not buying actual Bitcoin. This is a big misconception. Like if you were to take a long, right, on a perpetual contract on Bitcoin and you're using leverage, you're not buying actual Bitcoin. The same thing is for shorting it. You're not selling actual Bitcoin. It's a derivative. Anyways, so why isn't this at like 3% or at least higher, at least equivalent to this or more than it? That's the first red flag. And then the volatility that comes in after. So next red flag. So then do you short it here? Because you think it's going to do this. So do you short it here? I mean, you could. It's pretty aggressive, but a lot of people that shorted it here and had their invalidations up here got popped, lost their short positions. We filled the area we were supposed to. Bears showed good fluidity, and then we get the dump. Was annoying. It didn't sweep then again, but too weak. The liquidity map was stacked at 96. Yeah, the liquidity map is, I wouldn't call it inaccurate. It's just a rough estimation. And just because there's a lot of liquidations sitting, like let's say that there's a lot of liquidations sitting up here, right? What you were commenting on. It's one step at a time. It doesn't mean we're just going to teleport up there and take that out. Like, is it possible that the short I talked about here lost and it pumped? Yeah, it's possible. And you could have been right about us sweeping this first before it. And then I would say the same thing. Okay, look here to short. We can't force what we want on the market. We have to be open to what the market is giving us. You can't force it and be like, okay, I'm only going to short if we go up here. Well, maybe we might. But if this trade lost and this one won and did the same thing, you would still be net profitable. Yeah, I mean, you don't have to. I've said it so many times. You don't have to use liquidation heat maps. You can see it all in the price anyways. It's something that it's like any other tool against the price. It's something that, like, you know, I've used this analogy, like the price is the steak and the other outside tools will be like the salt and pepper. Like salt and pepper without a steak is nothing. A steak without salt and pepper is still a fucking steak. You don't need it, right? If you don't understand what the price is doing, then it's not valuable. But, you know, this kind of stuff it's all mapped out on the price. And yeah, I mean, one of the big misconceptions, because I know this because I did the same thing, but like when you're let's say you've been trading for a year or two, right? You will think that you have mastered the candlestick, the price action, right? So you'll think, okay, well, I can see what everybody else sees on this chart. It's a fucking candlestick chart. It goes up and down. I can see the lows. I can see the highs. Everybody can see it, right? So there must be something else I need. Because this candlestick chart is not enough. I need to use some sort of fancy tools. And these fancy tools will be flashy. They'll be bright with different colors. And some guy on the internet will be saying, you know, you got to use this fucking indicator. It works fantastically. And there might be some truth to that. I mean, maybe that individual does have a lot of success using that whatever indicator. But I can tell you from my own experience, I've been in this game for a long time. I've used a lot of these indicators. I've tried to get them to work. They're not as good as it might seem to somebody who's new. And when you and I look at a candlestick chart, yes, we see the same amount of red candles and green candles. We see the highs, but do we see everything the same here? When two people look at a picture, they could see two different things. That's why, you know, art exists, pretty much. The interpretation of it. So I'm not discouraging you from going out there and trying indicators and trying the vast majority of moving average strategies or the volume profiles or whatever you want to use. I'm just challenging your belief that you have mastered the candlestick chart. And I'm not doing that to be a dick. I'm trying to save you some fucking time. Like, you can use outside tools, but I wouldn't suggest using outside tools until you have a pretty strong grasp of how the price works and how much weight to give the price. So let's say that you're really good at analyzing a price chart, a candlestick chart. So you think to yourself, okay, I'm going to throw some indicators in there to squeak out any extra edge I can get. Let me see if I can get a little bit more of an edge. One of the big issues that you might cross is giving too much weight to those indicators. Like, oh, this steak only tastes good because of the salt that's on it. Or this steak only tastes good because the pepper's on it. That's not true. So if you are to eventually add indicators back into your arsenal, one of the biggest issues that you could come across is how much weight you give those indicators and knowing how much weight to give them. And so for the most part, it's not even worth doing it because you don't need it. But some people might feel tempted to try and squeak out even more of an edge on the chart, looking for whatever edge they can get to slightly increase their probability. Which, like I said, can be advantageous, but is extremely tricky to do and full of a bunch of pitfalls. It can be advantageous. Like, I'll throw in RSI every once in a while. Which, why isn't my RSI working? I'll throw in this every once in a while. But just because I don't lean on this to tell me where to enter a trade, to tell me where to exit a trade. And I'll look at volume sometimes too, but it doesn't, I don't derive, you know, the chart's going to do X, Y, Z. I'm going to enter here and exit here because RSI is overbought and there's a lack of volume and stuff like that. This one as well. Order books can be messed with a lot. Looking at order flow and order books is just another seasoning to the steak. I think what a lot of people end up doing is they believe that they have this part down, and so they have to find some other reason as to why they're not having success. There's got to be some holy grail out there, right? It's in the order flow, it's in the moving averages, it's in the volume profile, it's in the VWAP. That's what I'm missing, because I know I have this down. It's an ego thing, right? People think they have, think about it in sports, right? People think they have the fundamentals mastered, so it must be something else. It must be the equipment I'm using. So say like you're golfing, right? And you're like, I know all my putting is good, my driving's good. I have the fundamentals down on golfing. It must be because I don't have good enough gear, so let me go get better gear. And what is the result? Maybe you have a slightly better golfing game because of the better gear, but the reality is that you have the same fucking game. This is why you don't need 15 monitors to trade. It's just like trying to find these little things because you don't want to accept that you don't have the fundamentals down. I would take Tiger Woods using the worst equipment possible, right? Tiger Woods using a hockey stick would probably kick your ass using the best gear that you can in golf. Give Tiger Woods a fucking hockey stick and he'll probably still kick your ass at golf. At least in putting, you know. "19 monitors, 3 keyboards. I'm a hockey player, my slap shot will fuck him up." But like in any mastery or any like skill that you could, if you look at the people who are at the top of that skill, what will they all say? Discipline. Discipline and fundamentals. Let's say you're playing like a video game, right? Like a competitive video game, and you're like, oh, I need a better response time on I don't know all the technicals for this. I might be wrong on some of this stuff, but I need a better monitor because the response time is slow, and that's why I'm losing. Or I need better internet because my ping is higher, and that's why I'm losing. I need a better mouse. What's the best? What do the pros use? What mouses do the pros use? What keyboards do they use? You know, all that kind of stuff. Well, that can be slightly important. I mean, certainly if your ping is like 1,000, that's going to be important. But if your ping is only one notch higher than your competitor, then you might think that that's the reason why they're better than you. And if you follow that pipeline, you'll never get better. It's about accepting that maybe you can get better at the basics. But that hurts the ego, right? Because we all want to accept the fact that we're good at the basics. Yeah, yes, ping does matter to some degree. Maybe that was a bad example. But like, let's say, you know, one guy's got a ping of 20 and another guy's got a ping of 21. The guy who has a ping of 20 and the guy who has a ping of 21, you know, it's very marginal. Like, it might have a slight impact, but it's certainly not going to be the reason somebody wins or loses a game for the most part. The better player is often going to be the winner. And what makes someone a better player is they don't have an ego and they're willing to work on the fundamentals. I mean, how many musicians had really bad musical instruments, like relative to the top of the line stuff, but still had a lot of success? I mean, is that not just a musician in a nutshell? Like some poor artist, musician, who doesn't have the best guitar, doesn't have the best drums, but still eventually reaches the top. And then you have some guy who, you know, their parents are really rich, so they buy them the best state-of-the-art equipment, like the best guitar that money can buy, the best drums that money can buy, and what becomes of them? Well, maybe some of them find success that route, but the point that I'm making is that you don't need necessarily the best equipment as long as within reason, right? Within reason. I mean, you can't just you know, take a stick and put some strings on it and call it a guitar, like within reason, right? So I know that was very long-winded, but I'm trying to make the argument that there's a lot of value when it comes to trading and trying to determine where the price is going to go next. There's a lot of value in just using the candlestick chart and trying to get better with it. And then, if you believe that you mastered it at some point, which is tricky because the ego comes in, then you can add, you know, fancier stuff if you want. But yeah, it's applicable to anything really in life. It's just in trading, it's, you know, going to be very obvious very quickly because realized losses or realized gains are going to be in your face, and it's going to happen pretty fast. Like, there could be some trader, right, out in some third world country who's on like a shitty laptop, but ends up being like, you know, one of the best traders versus, you know, some person in a first world country with 15 monitors, the highest end PC, and like will never have success in trading. Or they're just trading, they're in a third world country trading on their phone. Sure, there's a variety of people in the chat. I'd probably just describe some people in the chat on both ends. There's probably some people in here who don't have a big trading account, they don't have the fanciest equipment, and there's some people in here who have a big trading account and have the fanciest equipment. And in trading, the playing field is really leveled. I mean, not to shit talk hedge funds again, but they have all the state-of-the-art equipment, right? All the best state-of-the-art equipment. They have, you know, higher tier level data. They have multiple heads working on one trade. They have they have, you know, plenty of money. They have every reason to have success in the market. Yet most hedge funds don't beat the market. Now, there's reasons for that, but, you know, a hedge fund is there so that if the market crashes, you'll take less of the pain. So if you're going to go that route and you're going to hedge, then you'll have less of the gain. But I mean, it doesn't mean that that's a 1-for-1. It doesn't mean that just because you're protecting your downside doesn't mean you can't beat the market. In fact, if you're good enough, it's almost the opposite. Now, the reason why, like, since I started talking about this and the viewership has dropped, is because nobody wants to fucking hear what I'm saying, even though it's important. Risk management is important, fundamentals are important, but nobody wants to hear that shit. What would you guys rather hear? Oh, you need to turn on this indicator here, and then wait for it to hit the buy area, and then you press buy, and then you print money forever, and you're a trillionaire living on the beach somewhere. And you have a Lamborghini, you have a hot wife, and you have all your money dreams come true. That's what people want to fucking hear, and they'll never find it. They're just gonna continuously be in the rinse cycle. I need that indicator. Which one was it again? All right, so here's how it works, guys. You go to tradingview.com. When you get there, you'll see charts. You want to click on the charts, and then in the top middle of your screen, you'll see a button called indicators. You turn on this indicator, and then it'll tell you how to make infinite money. This indicator right here, all you got to do is follow these rules of it, and you have infinite money forever. Doesn't that sound like a great deal? And don't worry, it's never wrong. So you can go full 100x in with all of your money at any time the indicator tells you to buy or sell, and you're good, man. People love slop. They love that shit. Because it's easy. Already have a hot wife, but the beach sounds nice. Or here's what you do. You give your money to a wealth manager, and then you're fine. You don't have to worry about it, right? You listen to a financial advisor, and whatever he tells you to do, you do, and you'll make money and you'll be fine. That's another one. And the only reason that one's true is because of inflation, like I said. The only reason, Bob the financial advisor has had so much success is because he buys and holds something that's traded against the dollar. And the dollar just loses value. So easy win. Why can't you do that? If Bob's job is just buy and hold, why do you have to pay Bob to do that for you? And then actively managed funds, right? How good are those guys? Some of them are really good. Some of them are really bad. Well, how do you know the difference? Look at my quant. He's Chinese. He won a math competition. I don't know, man. If you have a decent amount of money, you should be at least a little bit literate on how markets work. Otherwise, you're going to be paying 2% management, 20% profit, which eats into your compounding like a motherfucker. Look at it fly. Look at silver. Silver's been in the wings. It's been in the hangar for so long, waiting to fly. But now that I've said that, tomorrow silver's going to come. But what could throw a wrench in a silver rally like this? The stock market crashing could do that. But how does the stock market crashing, how does it affect silver? They're two different things, right? Maybe. It is a good movie, though. I agree, champ. Yeah, if you want to watch a finance movie, most of you guys have probably already seen it, but it's actually not just a finance movie, it's more of a Hollywood entertainment, but it has sort of both of them mixed in. It's called The Big Short, although I'm sure almost everyone in this chat has seen that movie. It's a good movie, though. Next time your wife wants to watch a movie with you, put on The Big Short, because it's a finance movie, but it's still entertaining. It's still good for somebody who doesn't really, know about finance or anything like that, because it talks about 2008 and what happened in 2008, which, most people in the chat were probably alive to see that. Yeah, Margin Call's another good one too. People in the finance world say that Margin Call's the best finance movie. I don't know. Being the best finance movie doesn't mean that it's only about finance, because then no one would watch it. You also have to throw in the other side of it, which is the entertainment value. So if you're gauging it based off of how accurate it is to the finance world and how entertaining it is, I would say Big Short's probably better. But if if you care more about like the accuracy of the finance part, then probably margin call. Yeah. But yeah, Burry, I believe he still has his shorts open on Nvidia, and I think they're not bad shorts. I mean, I think it's probably not smart to short Nvidia in general, but yeah, next spot is here on 190. It has to reject 190 to continue the fluidity. Bearish fluidity is still pretty good so far, so it held this, it's done everything it needs to do. Then you look here, this is a decision point, either new all-time highs or that is where the decision point is on Nvidia. Like 191, 192. But the fluidity is nice, man. Makes it easier to predict. It could dump before that, but he still has a short on Nvidia. Why did my YouTube fucking break? I'm gonna refresh it. What the fuck's going on? Is the stream still up? My fucking YouTube window just decided to break. Stream still up? Okay. There we go. Muted, unmute. It's very rare that stonks follow the fluidity so nicely. Like most of the time I'm not that confident in my analysis on stonks because there's a lot more that goes into it than just technicals, but Nvidia in particular, where it's at right now, I'm actually pretty confident in it. This is decision point, right? So if you're an options trader, this is where you could set up an iron condor or something, because there should be an exaggerated move with like not only volatility, but volatility that has a trend to it. If Nvidia tests around 191. There's any kind of hedging strategy at 191 if you're expecting volatility and a strong trend to come afterwards, I think that's where it's going to happen. Because it's following the same logic of the structure. Nvidia's in post market right now, by the way. It's not open. It's just Burry has a short on them, and then who else is Burry shorting? Isn't it like fuck, I can't remember. I know his Nvidia short position is pretty big though. Palantir. Oh yeah. I don't trade Palantir, so, but last time I looked at it, it looked pretty bad. Yeah. Yeah, this chart doesn't look that good. I mean, it could still pump, right? It could still be wrong, but decision point on this one is the same thing. You've got equal lows, fragile structure on bottom. Leverage market seems to be stacked in the same spot. If you get like a clean rejection off 188, then probably that. Let me make sure I'm not missing anything. Yeah. But if there's no clean rejection at 188 and 190, then that. So decision point here, which would determine whether one of these two things is likely to happen. He has almost $1 billion short, 66% of his portfolio on Palantir. I think his Nvidia short is better than his Palantir one. I don't know why he's loaded up so much on Palantir. Probably some fundamental reasons, right? Like, oh, their PE ratios are too out of whack. Well, who the fuck cares about PE ratios, dude? I mean, yes, they're important, right? PE ratios are important, but not in the market conditions that we're in right now. Nobody cares about PE ratios right now. What do they care about? They care about buying the winner and adding on to the winner. Fundamentally, PE ratios, price to earning ratios, are important, just not right now. Because we're in a market of greed. This is a greedy fucking market. He's using options to short it, which isn't technically called shorting it, but for pragmatic reasons, we'll just say shorting because he's betting that the market will go down. But he's using options to do it. Like when I say short or long on like on a stonk, There are products where you can short or long it, but the vast majority of the volume is in the options market. So when I say short, I'm just referring to puts. When I say long, I'm referring to calls. It is technically a zero-sum game, but it doesn't become, the realization of zero-sum doesn't come into the picture until the markets crash. So it's not, you can argue it's zero-sum, but my counterpoint to that is that as long as there's money in the markets, then it's not zero-sum. Well, yeah, time decay would be a good argument point, yeah. But when you go into time decay, like, that's relative as well. Like, are you going to be alive in 100 years to realize the gains on some stock you bought? And then options is like, are you going to be alive in the next 3 months to realize? So yeah, I mean, you're technically right. There is time decay, but there's time decay in everything. It's just how much time. I've dabbled in options. I'm not the smartest guy when it comes to options, although I probably should invest more time in getting better. It's just, I don't want to, you got to learn all the Greeks. There's like all these little pitfalls with options. I don't know. I think with my abilities to read a chart plus somebody who's really, really good with all the pitfalls and options, probably make an arm and a leg. But I don't need to do that, right? Futures are enough for me. I've definitely played around with options over the years, though. It's just not, I don't know. I've always been attracted to futures. Alright, I've been streaming for a couple hours. I'll probably call it. Here's the link to the Discord if you want to join and you're new here. I need to work on the next part of the series for YouTube too. I know you guys have been asking for it, so I need to work on that soon. I don't know, are you guys enjoying the series so far? And you have to start with the first one because it talks about risk management. Trent? What is Trent? Should I know what this one is? Trent Limited? What the fuck? I should know what this is. Look at the fucking rocket that took off. Am I a dumbass for not knowing what this is? What is this? Oh, he doesn't know what Trent Limited is, dude. He doesn't know anything. This guy's a dumbass. What the fuck is this? A fashion brand from India. Ooh, fashion brands. Uh-oh. Uh-oh. Yikes, that's brutal. Okay, good fluidity, and then just devastation. I mean, what do you want me to say about this? It's it looks like it's gonna keep going down. I got some bull div, lots of equal highs. That's good for the bulls. This is really devastating right here. Because it was perfectly set up to go and start the rally again, but that just means overwhelming demand. I'm sorry, supply. Yeah, fluidity was good here too. Oh my god, this chart is getting slaughtered, man. It's doing, like, everything in the chart for the bottom side is done very well, but there's just not enough demand. I mean, obviously that's the case, right? The price going down, it's pretty simple, but okay, you have a void here, so let's see. Okay. Okay, so if it does kick up, because there is some bullish divergence forming, if it does kick up, then you want to see how it behaves here, because we went straight down here, right? So we should be able to go straight back up. But if we don't, and you start to see weakness here, like something like that, then this is an area to look to short it. Basically, if it kicks up, it should kick up in a big way because we went straight down. If it doesn't, then that's pretty weird, and it should be an opportunity because it's showing you where actual supply and demand is. Anytime you enter an area that the price should do something and it does the opposite, that's a reflection of what the true supply and demand is. And it's hard to tell what the true supply and demand is, like when we're just in the middle of a range here. Like all we're doing is like these little movements right now, so you don't really know what the true supply and demand looks like until you enter an area that would make it more obvious. Because people will claim they know what the true supply and demand is even when we're in these kind of ranges, but that's assuming that other market participants won't come out of the woodwork. Like same thing with an order book. You can have a general idea of how much demand is out there, and this is also applicable to OTC as well. You can have a general idea of how much supply and demand is out there, but one of the beauties of the market is you can never know for sure. And if you think that you can always know for sure, you're going to keep putting on big bets until the market rears its head at you and then knocks you out. Fashion comes and goes. Yeah, that's why I kind of scoffed at it being a fashion chart. Nothing against Nike either, right? But like you said, and I agree with it, fashion comes and goes. Usually is once the party's over for a fashion company, the party's over, man. There's no more drugs in the food. There's no more party. You check out XMR. Yeah, I can look at Monero if you want. It's just, I guess everybody wants to look at Monero because it's one of the only things that's not really doing too bad. Yeah. It's good fluidity so far. Held this, got a little messy. Good fluidity topside. It's fine to chart nicely. Next spot would be here, which is held. Next spot would be here. Okay. Let me see. It's never tested on the local. Okay, you got equal highs as well. The fluidity's already been tested. A little bit of a front run, but that's not a big deal. It looks pretty good. You don't really want to come back down here, but if you do it quickly, then there's a cheeky opportunity to try and hop on the train before the pump. If it doesn't hold this, and we can just marry the box together. Let's put it like this. This is the best one, but it depends. If you really want to take the trade, right, then you might have to go for the top of the box because they might not give it to you. But if this fails here, then that. If this holds, then that. Yeah, this is already done. So this is already tested, which means if you return to it, you'll either stack equal highs, which means a small dump from here, or you'll just go for it. You have good fluidity on bottom side as well, so this was all done perfectly. Volume is kind of lackluster, but it's not a big deal because we haven't gotten a new high yet. If we go for the new high on it, we should see an increase in volume to signify a healthy trend. So if it goes for the new high, we want to see volume bigger than this volume. You don't need it, but it's better to have it. Yeah, and then local structure is this here. So this held, next one held, right? Even on the local, it did it quite nicely too. So this held, this held. Next one is here, which held. And this last one up here, which we already dipped into it, which could be a sign of the structure breaking, but that's a more local structure that broke. It's not that big of a deal. More bullish and bearish. This is technically a break of structure here. What happened right here? But the recovery is quite nice. So yielding to more local, I guess. It's basically since this already broke. If this doesn't hold, then you'll likely get a low lower than this low, which is the doom arrow. And if that doesn't hold, then you have to catch it in the void here. If it's caught in the void, then it can recover. If it's not caught in the void and we test down here, then the whole thing breaks. So first break of structure sort of already happened. You don't really want another one on the local. If this breaks, then you go lower than this low, and then there's a distance between here and here that you can catch it. You can catch it, which would save it. If it's not caught there and we even revisit 172, then we should get a low lower than 90. Yeah, it doesn't look bad though. It definitely looks better than a lot of the other altcoins out there for sure. A lot of the local stuff's holding too, which is good. If you wanted to short it, okay. If you wanted to short it, yeah, that lines up. Okay. 420. Last spot to short, this thing is 420. If it doesn't dump from 420, pump it. So if you're long and strong, or you have a spot bag and you're looking to defend your downside if this thing breaks, 420 doesn't look bad. If the 420 short gets stopped out, then we start to clear equal highs, and we can form equal highs up here, and then eventually go for it probably. I don't like to speculate that far into the future, but the next probable move, it depends. Like if it goes high, then 420 short. If it goes low, then we have to hold 375 all the way down to 350. That looks right. Yeah, that looks fine. It's gonna do a Luna. It might do the Luna. Monero's similar to Zcash. Die-hard communities, right? Every financial instrument is just a die-hard community, and which one is the most cult-like? With the PE ratios how they are right now, you can make that argument for any stock. Like, let's say like Tesla holders or Apple holders. These are all just cults. Once you get past a certain PE ratio, it doesn't make sense to buy it unless you're part of the cult. Like even Apple buyers, they're all just one big cult. Same thing with Tesla. Amazon, I'd argue, you know, I just think Amazon's stronger because their execution is just so fucking ruthless. Google, same thing. Guys, if we all hold, we go to the moon. It's literally, once the PE ratios get that far out of whack, then that's what these are. You can call them investments if you want, but that's what they are. Google, Nvidia, same thing. Microsoft, same thing. But sir, these companies make a lot of money. Yeah, but do they make enough that would make their price evaluation reasonable? Is their price evaluation reasonable based off how much their earnings are? If we look at historically what happens. Meta, same thing, yeah. I didn't take this, but you guys asked for it, so. Next one is here. What is VLO chart going to do next? What kind of company is this? Yikes, that's good volume though. "3D printing? I don't know. You would probably know more than me certainly when it comes to that kind of stuff. I don't know if how viable it's going to be in the future. Like, here's the two questions you got to ask yourself: will this industry continue to grow, and will this company continue to take market share and be competitive in that industry? I don't even know if the industry is going to continue to grow, nor do I, and I don't know if this company is going to be competitive. But I can tell you what I see in the chart. I'm sure 3D printing will continue to grow, right? As long as the economy is doing well. Okay, that's good. 974 because of this. And there's a front runner liquidity here, so it'd be like diving into it. You have the same thing. Bottom side's kind of weak. Front run on that too. Yeah. Okay. Yeah. If this thing does rally, I mean, if you're bullish on it, turbulence could be expected here above 10. If it gets through that, it has room to run though. Looks like it. This chart's harder, man. I'm not too confident in my analysis. What's good about this chart though is the volume spike. This is really nice. Thesis on that robotics 3D printing will outperform soon as labor shortage play. Okay, I agree with that, but how long do you think that'll take? Do you think the predictions of where robotics and 3D printing is going or do you think they're realistic in the amount of time that they'll take? Or do you think a lot of the speculation, a lot of the narrative that's out there is aligned with what those people are invested in? So to put that simple, are the people that are saying that we're going to robotics and 3D printing is going to explode, and are they also invested in those things? I'm not arguing that they will. It's just like, how long will that take? And will there be, like, the way I look at it, I don't think there's going to be a labor shortage anytime soon, unless, I mean, I guess there could be, but I don't think there's going to be a labor shortage. I think it's pretty likely that unemployment's going to rise. As bad as that is. Maybe way later down the line that might be right, labor shortage, but I don't think that's where the playing field we're at right now. I think the job market is extremely competitive because of what the unemployment numbers are looking like. Here's unemployment. It's not too bad right now, right? It's sitting at 4.4. But anytime unemployment starts to rise, it usually doesn't stop until it hits something a lot higher than 4.4, as you can see on the chart. It's at resistance. It's at support right now. But yeah, and unemployment obviously is not the best metric because it has flaws, but the flaws that are within the unemployment metric are usually trying to make the number look better than what it is, not worse. So even though there's there's certainly flaws in unemployment, but the flaws help the number go lower, not higher. Tariffs bringing more factories to the US. Yeah, I don't know, man. But the thing is, like, there's certain markets where you're going to have more demand for labor, but what is the overall market? Who can tell me why unemployment is a flawed metric? It's not so flawed to the point where we can't look at it. Like, it's still good to look at. But anybody in the chat, I've said this before, so I want to see who is around a lot. Why is unemployment a flawed statistic? And this is actually this is with the DoorDash and the Uber and all that kind of stuff. I actually think it's more flawed than it ever has been. Unemployment doesn't, I'll just answer the question. Unemployment doesn't account for underemployment, and it only accounts people that report the unemployment to the government. So if somebody doesn't report to the government that they're unemployed, then it won't be found in the statistic. And then also the bigger one, which is underemployment, which is people have jobs, but they don't have as many hours as they want in those jobs. So they have jobs, but they want more hours. That's not shown in unemployment. That's one of the biggest reasons that it's flawed, because with DoorDashers and Ubers and all that stuff, and then also like part-time gig workers, all that kind of stuff, that's not going to show up in the unemployment. I mean, it might a little bit, but not as much as maybe people would argue. So the reality is unemployment's at 4.4, but it's probably way higher right now. The true number is probably like way up here or something. I'm speculating, but I would guess it's a lot higher. That's probably too dramatic, but it's higher, right? But anytime unemployment starts to rise, it continues to rise until we've hit the bottom. And the reason why is because of how the downward spiral works. If companies start laying people off, right? If people lose jobs, they're less likely to have money to spend. So that means companies will make less money because they have less consumers, because they've laid people off. And if companies are making less money, they're going to fire even more people, which leads to even more people not spending money, which leads to less consumers, which that's where you enter the downward spiral. And exuberance just gets wiped out. Greed gets wiped out. And sort of the backbone of the economy are the market participants who are not overly exuberant. Kind of save the day. What's up, Curly? Sort of the no-name, no-face guys save the economy. Those are the same type of guys who also save social politics as well. The unsung hero. I said I was going to end, and then I streamed for another 20 minutes. No, I'm not talking about like bad actor anonymous. I'm talking about like anonymous, like your what is an example of this? Like a business owner that isn't exuberant. Let's say like the opposite. This is gonna sound bad, but like the opposite of like a Michael Saylor. Nothing against him. I'm just saying he's a bit exuberant, a bit greedy, but like the opposite of that. And in politics, it would be like the moderate. Like when we can see the same thing happening in politics. It's usually the people that are willing to have conversations that and are not radical on either the left or the right that end up saving the day. People that are hell-bent on one side of the aisle, those people end up expediting the collapse. In fact, a lot of the time they make money off of it collapsing. Warren Buffett. Yeah, I'm not necessarily talking about investors, more so like business owners and that kind of stuff. What'd you guys do to Ethereum, man? Why'd you guys beat up Ethereum so badly? The issue is at some point in Empire later down the cycle, it's more and more rare to find non-exuberant participants. Like the further down you go the cycle, like talking about America for instance, the more popular it is to be part of the exuberant class, part of the radical class. I mean, look at politics or economics. If you look at politics, has there, in the last, I don't know, couple decades, has there been a time where there's been more polarization in politics? More people who are willing to draw a line in the sand and not talk to the other side? More us versus them type mentality. And then in economics, everybody's greedy right now. There's been times where everyone's been greedy in the past, but everybody's fucking greedy right now. So you have to hope that the backbone can actually support it when it breaks. And the later you go down an empire cycle, the harder it, the less likely that backbone's going to hold. Maybe that's why a lot of people are selling bonds. They don't want to be in. They don't trust the U.S. anymore. I mean, you got rate cuts coming, right? People wanting to lock in bond yields, lock in rates, but still yield goes up. This shouldn't be happening. I mean, it can still fail, right? Which is what would be ideal for the United States. But certain behaviors that are abnormal, if they continue to repeat, should be examined. Because they could have, bigger ramifications. There's a 10-year yield right now. Should be doing this. Alright. I know you guys just come here for the trading stuff. You don't come here for me to just fucking rant about these kind of things, but I'll end stream now. Let me get some GGs in the chat. You guys stuck around. Where are my lurkers and my view bots at? Get some rigs in the chat. GG. Come on, where are the view bots at? With everybody lurking it here, it looks like I am view botting. There we go. Lurking for 2 hours. Beach. Yeah, where is Beach? Has anyone seen Beach? It's probably at the beach. Redlands, let me guess, you're in a landlocked area, or you're far from the ocean, aren't you? You keep bringing up the beach. Norway. Alright guys, have a good rest of your Monday. Be safe out there. The VOD for today should be posted probably in a couple hours. So it'll be up on YouTube if you missed the beginning part of the stream, which is where I go through high time frame analysis on Bitcoin, stock market, Ethereum, gold, silver, oil, the dollar. And then there's some parts of the stream that will probably be better for the people that are traders in the chat to go through. I explained some concepts that I think are not really talked about on the internet, and I think are really important, particularly if you want to get into scalping. Alright, GG's, y'all.